To trade a currency, we need a pair of currencies to actually trade. So if I have dollars and you have dollars, then there's actually no point for us to trade, right? I'm just going to be giving you 100 and you'll be trading 100 with me, which is absolutely pointless. If I have dollars and I want euros, then I can trade with you to swap those dollars for euros and you'll get the dollars you want. And it's exactly the same with crypto as well. You can see here on the trading screen, we have a currency pair right here, which is actually Bitcoin against US dollar Tether. So we want to sell one currency to buy another, and we can swap fiat for crypto, crypto for crypto, or crypto for fiat. It really doesn't matter. So let's come over to the Binance page as I showed you before. Now, the most common pair for any crypto is with US dollar. So prices are quoted for US dollar exchange. US dollar is the world's reserve currency until Bitcoin takes over, of course. But if we come back to the slide, what we can actually see is a currency quote is really split into that base. Now that's on the left-hand side, and then the quote, which is on the right-hand side. The base currency is the main currency that you want to buy or sell, and the quote currency is the secondary currency usually that we're selling, but you can buy it as well. But essentially what happens is that the base currency is the main currency, and that's one unit of that currency, right? So on the left-hand side, and I'll show you this in a second, we have the base currency. We have 1 unit of that currency. On the right-hand side, you have the quote currency. And what that's telling you is how many of that currency on the right-hand side do we need to buy or sell 1 unit of the base currency on the left-hand side. So just to show you how this would work, let's go over to a drawing right here. So we have the base currency on the left-hand side. In this case, it's actually going to be Bitcoin. So I'm going to type BTC here. So this is Bitcoin. This is the base currency. Okay. Now, what happens is we have like a line or a slash. So we know that that is the base currency. On the right-hand side, we have the quote currency. So in this instance, I'm just going to put US dollar. So that's really, really simple. We have the base currency on the left, and we have the quote on the right-hand side. Now what happens is that you need some sort of price or change, right? So you obviously get a quote, and this is how you get your quote. So we know that we have 1 unit of Bitcoin, we have US dollar, and then what will happen is that you just get a quote, so 50K, right? So what does that actually mean? Well, it's going to take 50,000 of the quote currency, in this case US dollars, to buy 1 unit of Bitcoin. Let's clear all that and do another one though. So we've got this time actually ETH against US dollar. Again, ETH is the base currency here. So this is the base, and then US dollar is the quote currency. Once again, what we're saying is how many US dollars does it take to buy 1 ETH? And in this instance, let's just say 3,000. So now we know that ETH is the base currency. It's on the left-hand side. We can actually change the quote currency though. So I'm just going to delete here. So maybe we don't want US dollar as the quote currency, but we actually want Bitcoin. So we can do that. We have ETH on the left-hand side. Then we can actually have Bitcoin as the quote currency. So how many Bitcoin does it take to buy 1 ETH? As of making this video, it's about 0.07. So again, just on the left-hand side, the base, how many of the quote currency does it take to buy 1 of the base currency? You can also just have this as a percentage. So let's say Bitcoin appreciated against the dollar today. So obviously Bitcoin would be the base against US dollar. What's the percentage change of this? Plus 5%, say. What does that mean? Well, essentially it takes 5% more dollars to buy the same amount of Bitcoin, which is 1 unit. Coming to the Binance trading page then, pairs are usually quoted in the way that suits most traders, right? So most assets will trade against dollars. So dollars is usually on the left, unless you're trading Bitcoin, obviously, which most people would want Bitcoin valued in dollars because that's the trade that most people will do, swapping dollars into Bitcoin. So if we're selling dollars to buy Bitcoin, how would we go ahead and actually do that the other way round? Well, if you come over to the right-hand side of any trading screen or wherever it is, you can just simply buy and sell. So you can actually swap it right here. So it's not like a different trading pair that you need. That will obviously do that calculation for you. So buy, sell, but just the quote itself, we know that the Bitcoin US dollar quote is whatever it may be. And then we can just switch that around to buy sell. So, if you're selling 1 unit of Bitcoin, that's getting you 50, 60,000 US dollars. Cross rates is something that we have in traditional FX markets. Any currency pair that trades that doesn't involve the US dollar is technically known as a cross rate, so a cross exchange rate. So in the crypto world, yes, we have stable coins, right? So we have US dollar Tether, USDC, USDT, BUSD, all of these coins that you can see here, and some other ones as well. They obviously represent the US dollar in the crypto world, right? So US dollar isn't a cryptocurrency, and so it can't exist on blockchains, which obviously limits its use. Yes, you can use US dollar on centralized crypto exchanges, but you cannot use US dollar on any blockchains specifically. So that is why we have stable coins, to facilitate that US dollar on blockchains. What happens though if you want to exchange two cryptocurrencies without the US dollar? Well, all pairs have a US dollar stablecoin and probably a Bitcoin pair. So if you want to trade anything in crypto, you will find a US dollar stablecoin currency pair to trade it with, either buy or sell, and Bitcoin as well, usually. Bigger cryptos also can have a direct pair to trade with, right? So if you want to trade Cardano and Ethereum, or Cardano and Bitcoin, you will find that currency pair. If they don't know, especially for smaller currencies, then what you have to do is basically trade into either US dollar, like a US dollar stablecoin first, and then to the other currency. This is for centralized exchanges. So on a DEX, on a decentralized exchange, it's going to be a little bit different, where you will always find a currency pair with the base layer coin. So on Ethereum, if you wanted to trade any Ethereum coin on a decentralized exchange on Ethereum, that will always have a currency pair with Ethereum itself. So essentially what we're doing here is, if two small cryptocurrencies don't have a currency pair, you're going to have to trade through a bigger currency, whether that's the US dollar, Bitcoin, or the base layer coin of that pair. So if you cannot trade two currencies directly, then what you're going to have to do is basically go through a bigger coin or token. So to prove this here, I do have a smaller token. Well, it's not small, but we have Aave. So we can come and we see Aave against the US dollar, but we can actually just look on here right now. So, let's say we've got some ETH pairings right here. So a lot of coins that are on the Ethereum blockchain will have a trading pair with ETH. So we can see Aave trades against ETH. We've got ADA right here, ADX, AXS. A lot of these are built on the Ethereum chain. Of course, we have fiat currency pairs. Now, virtually everything trades against US dollar Tether. So if we click US dollar Tether, you can see a long list that trade against it, right? So we value cryptocurrencies in dollars, and that is why US dollar is considered the quote currency on the right-hand side there. And then for alts as well, we can click on alts. You can only see 3 different altcoins right here that have currency pairs. So we can let's say click on XRP, you can only see one currency pair there, which is Tron Network against XRP. So if I wanted to trade, let's say XRP for another coin, let's say Axie Infinity, doesn't have a trading pair on Binance. How would I get value out of XRP and into Axie Infinity? I'd have to sell XRP, probably against a US dollar stablecoin, right? So that is selling my XRP into the US dollar. Now I have that value in US dollar, and I can go and trade that against Axie Infinity. An order book is the visual representation of a market. This is the actual market in any currency pair. So you'll see this on every advanced trading screen. What exactly is the order book telling us? It tells us absolutely everything we need to know about price and volume. So what price are people trading at, and how much are they trading? We can also join the order book, and you can join it in a few different ways. So firstly, this is really where buyers and sellers actually show their orders to the market, right? If you want to trade, you're going to have to at some point show your order to the market. So what we can see here is that we have sellers at the top, so obviously denoted in red. Now, sellers always want to sell for the highest price possible, right? If you want to sell Bitcoin, you want to sell it at $1 billion. That would be really great. So you always have a higher price if you're a seller. And then obviously we have at the bottom buyers, these are in green. These always want to buy at the cheapest price possible. Now it's really easy just to call these two sides of the order book, the buy side and the sell side. That's absolutely fine. A lot of professionals say that. Kind of a more normal way to say it in the industry would be a bid offer. So when you want to buy something in stock markets or currency markets, you make a bid. Okay, so if you are a buyer, you make a bid. You bid for something. Now, if you are a seller, you actually make an offer. In America, it's called the ask. So what we have here is the bid offer. So the bid is the buy side, the ask or the offer is the sell side. So what we can see here at the bottom is that we have the best bid right here. The best bid is of course the highest bid. So whoever's paying the most for something, whoever wants to pay the most for something is the best bid. And then everything below that, of course, are other bids, but they're not the best bid, of course. And then on the sell side, you have the best offer or the best ask, and then other offers that are above that. The reason these two are the best is because they're the closest together. The one who's willing to pay the highest and take the least will have the best chance of being matched. And of course, right in the middle, you obviously have the mid price there. This guy right here has the most chance of selling his Bitcoin. We're looking at the Bitcoin order book right here. He has the most chance because he has the lowest price. That's really great, but you don't know how much he wants to sell. Maybe he wants to sell like $10 worth and you want to buy $1 million worth. It's not going to work out, right? But on the right of this, we can see the volume. This is also really important. This isn't one order. This could be a group of orders. This might be 1,000 people or 1 million people or one person, but it just tells us the total volume that we can trade at this given price. What we can see right here though is essentially we've got 1.4 Bitcoin at this offer price. So if you wanted to buy, let's say 1.3 Bitcoin, you could go ahead and boom, trade that straight away. The volume is there for you to trade. Really important when you're trading, right? So let's say there's a really great offer and you think, yep, I'm going to buy at that price, but they don't offer you virtually any Bitcoin whatsoever. What that's telling me as a trader is essentially the real price isn't here. Yeah, you can trade a tiny amount, but the real price is maybe above where the extra volume is. So when you're trading, it's all about volume and price, not just price. Now, for most of us who are just buying a couple of $1,000 here or there or whatever, this is completely irrelevant. It's not going to matter. 1.4 Bitcoin, that's like 75 grand in this case, whatever it is. So it's not going to matter, but certainly it may if you're trading higher amounts. Here we can see the actual price. So yeah, my maths was off. It's $83,000, right? So $83,000 worth is on offer at this price. Let's come over to Binance and actually just see this in action. So I'm going to switch over to a very, very liquid trading pair, US dollar, and we're going to search for BTC. So US dollar tether against BTC. Now, it's a weekend when I'm filming this, so the volume isn't amazing, but we can see exactly what's happening here. We can see those bid offers constantly changing, and the mid price is when trades actually match up, when a buyer and seller make the same price. We can see the volume on the right hand side here changing as well as trades go through. So right now you can see there's 1.6 on the bid changing to 0.04 depending on the price. So we can see down here that there's actually quite a big buyer at 62,130. He wants to buy 0.16. That's actually not that much, but you can see that changing all the time, right? So this will change, the volume and the price will change over time. Something that we want to be really careful of is the bid offer spread. What is the spread? What is the difference between the best offer and the best bid? This is really important when it comes to more illiquid trading pairs. When you're trading Bitcoin, the bid offer spread is going to be absolutely tiny because you have more people wanting to trade, more people in the market, which just means more bids, more offers, more liquid trade. The spread is the difference between the best bid and the best offer. We can see on this current pair, the bid offer spread is absolutely tiny, right? So this is Bitcoin, the bid offer is very, very small. So what this means essentially is that when you're buying, let's say you want to buy some Bitcoin and you have to take the best offer, how much have you lost straight away? If you bought and sold straight away, you would obviously lose the spread, right? If you went and bought the offer and then sold to the bid, that spread, that is how much you lose. So that is how much you're down straight away. In Bitcoin, you're not down much because it's such a tight spread. Most cryptocurrency exchanges will actually offer you different fees, different trading fees, depending on whether you are a maker or a taker. So let's take the spread out of it. And we have the bid side at the bottom and the offer side at the top. So what we have here is the Bitcoin order book again. Now, what I want to do is show you the maker side. So let's say I want to buy some Bitcoin and I'm happy to buy at 58,548. 0.67. So, you know, where am I going to put my bid? I'm going to put my bid right kind of in here. Okay, so just to fit in. Now, I am bidding for Bitcoin with US dollar, but I'm not going to trade straight away, right? Because the market isn't there. We know the mid price is right here. It's above our bid. So I'm going to come on to limit orders and everything else later on. But if we put a bid onto the system down here, we are what's known as making liquidity. That essentially means that we are showing out orders to everyone and saying, hey, I'm out here and I want to buy some Bitcoin, and I'm going to show you my order and I'm going to show you the price that I'm willing to pay. I am making liquidity because I am putting it on the order book right here. I'm not trading straight away, but I'm putting it right on the order book and I'm making that liquidity. If you want to sell, you can come and sell me that Bitcoin. It works exactly the same if you are selling Bitcoin as well. So if you want to sell some Bitcoin and let's say you want to come in, you know, around here, around this price, again, you are making liquidity, you're putting your orders onto the system and you're creating a liquid market for people to go and trade if they want, okay? So you are a maker of liquidity if your order goes on the book and it doesn't trade straight away. So if you are a low bid or a high offer, a high ask, you are a maker of liquidity. The opposite of that, of course, is if you are a taker of liquidity, if you take people's orders off of the order book. So let's say I want to buy some Bitcoin, just want to get it done, and I'm going to lift this offer. Okay, I'm going to lift this offer right here. I take his liquidity off the book. I'm a taker of his liquidity. Now, makers pay lower fees than takers on most crypto exchanges, so just keep that in mind. It is not a massive difference, but it is a difference. If you make liquidity, you will usually pay slightly lower trading fees than takers. When we trade anything, there's really two main things that we need to think about. Firstly, how much of that thing do you want to trade? And then secondly, what price do you want to trade at, or do you even care what price that you trade at? Order types are going to let us control every different aspect of a trade that we possibly can. So the first type of order that we can come to is a market order. What is a market order? If you've ever used Coinbase or one of those consumer-friendly apps, you will be trading a market order. A market order lets you choose the amount that you trade, but nothing else. So let's say I've got £1,000 to trade, or you can say, you know, I want to trade 0.5 ETH or something like this. You can control the amount and nothing else. If you're a buyer, that means that you have to essentially get this price right here. So this is the best offer, and that's the price you're going to get if you're a buyer. You can't control it. Whatever that best price is in the market at the time, that's what you will pay. Conversely, if you're a seller, then if you're a seller of these amounts, yes, you can control that, but you can't control the price. So you're going to be coming down here and essentially getting the best bid, whatever that may be at the time. So this is exactly the same as going to an airport with, you know, £100 and saying, I want to switch it, and they're going to give you a price and you can't control it. Why use this order? Well, it's very fast, it's very easy, and it just gets the job done. So if the market is moving fast and you just need to get a trade done, then a market order is going to do that for you. The downsides of this is that you're probably going to get a bad trade depending on when you hit the actual button. You know, the market moves around a lot and you cannot control the price. And also we actually pay those taker fees as well, which are usually slightly higher on crypto platforms. So there's a few upsides and a few downsides, but let's see how to actually execute a market order on the system. We are going to be paying those higher fees, but let's give it a go. So just put in a market order. Going to be paying, you know, higher price, near all-time highs for Bitcoin, a market order, but we'll put it in, right? So market order, we're a buyer right here. You can see you cannot choose the price right now. So we're going to put a market order in. You can choose the amount that you trade. So do you want to do it in Bitcoin? So I want to buy 0.01 Bitcoin or whatever it is. Or do you just want to do it in dollars? You can see right here. So you can choose the dollar amount. So let's put in $15 right here. Then you just press buy BTC. That's done. Okay, because it's a market order. It is instant. You don't choose the price. You just choose how much you want to trade, and then bang, it is done for you. What is a limit order? Limit order is where you choose the price that you want to trade at. Okay, so you choose both the volume or the amount that you trade and also the price. The system will only trade if the price in the market matches your price. You actually put a bid on down here in the order book. You don't lift this price if you're a buyer. Okay, you don't do that. you come and join the bid right here, and you're not going to trade straight away. So what are the pros and cons of this? You choose the price. That is a pro. So you're aware of the cost of your order and you get a better deal than a market order, okay? Because you are certain of the trade price and you can put in a lower price than you would have to pay if you had a market orders, right? So we can enter orders ahead of time as well. That is another big positive. So you can actually put in orders. You can say, here's my limits right here. So you can choose the price. You can actually choose lower prices if the market's coming down a bit, which is definitely good. A con though is that we cannot guarantee that we trade. If you have a lower price and the price in the market is higher than your best limit price, then you aren't going to go ahead and trade. So this is good for planning ahead. It's not good for instant trading. Another pro though is that we make liquidity. So we get those maker fees, which are slightly lower. So let's go over right here to Binance, and we're going to put in a limit order. So again, I am a buyer. Okay, so I'm spending US dollar tether and I'm buying some Bitcoin. I want to go over to limit order this time, and I can see the mid price is 62,115. I'm going to put an order in at 62,1. I want it actually to be on the book, so I'm going to put 145, right? So hopefully it won't get hit. It's actually it's bouncing around, so let's do 62,120 like this, and I'm just going to choose amount again. I don't want to put Bitcoin. I'm going to put an amount of US dollar tether down here. So I'm going to put $15 like last time. So we can put in this limit order. So I'm going to put buy BTC. And you can see me down here. You can see my order right here, and it's going to bounce around. So I haven't traded yet, but I'm on the order book. So you can see me bouncing around 120. I think I actually traded, right? So it actually bounced around. Yeah, and I actually traded there. So you can see trade history, come down to the day, and yeah, we actually did trade at 120, right? So the difference is I got a better deal, and you can actually see this right here. My market order, I traded at 169. My limit order, I traded at 120. Why? The market moves around up and down, a lot. And having a limit order, essentially, number one, got me a better price, and number two, I've paid lower trading fees because I have the maker fees. So limit orders, probably the way to go for most people if you can do it that way. So next I want to come on to iceberg orders. What are iceberg orders? So they're a type of limit order. Now, when you're a big trader and you're trading a lot of volume, you might want to use an iceberg order. And an iceberg, I mean, we know what an iceberg is, right? So, we have the top of the iceberg, okay, we have the sea right here, and we have this huge iceberg underneath, right? So we can visualize what this means. You only show a tiny portion of your order to begin with, and then you have a much larger order underneath. Now, if you're trading large amounts, I used to get clients come in with large amounts. They would obviously tell me what their order was. You don't want to spook the market, right? If you're a massive buyer, you don't just want to say, hey, everyone, I've got $1 billion of Bitcoin to buy. They're all going to put their prices up. So what you do is you essentially take a portion of your order. So let's say this is your order, right? And you put it into tranches essentially. So what we say here is we're going to show this much, and you'll show that to the market, and that may trade. Now what happens is that the iceberg order reloads, right? So it's here now. So we now show this much, and when that trades, we'll go even lower still, and we trade this much, right? So essentially what we're doing is having a large order that we tell the system about, and we say we want to buy or sell this much, only show this much. So you can come and do that. So let's come over right here, and we can see it has to be a limit order, right? You can't use this with a market order because you can't control the price. So we come to limit order, and let's say we want to do $500, whatever it is, of Bitcoin right here, and we have an iceberg. So what does that actually mean? Put in the amount that you want to show the market. So we have this amount right here. So let's say 50. It says that the iceberg amount has to be smaller than the order amount. So what's that telling us? Yes, it's essentially going to take our $500 order, and it's going to split it into $50 orders, and it's only going to show those to the market one by one. If you're trading $500, $50, completely irrelevant. When I was trading, $1 million plus orders, then icebergs are important. When you're trading anything less than like a Bitcoin, it's irrelevant because we can actually see that the volume right here is quite high. So it's a good order to know, definitely, and you might want to use it in certain instances. But for sure, if you're trading smaller amounts, it's not going to be too important. So let's come over to stop orders. Next type of order is a stop order, and it's quite specific in how it can be used. So essentially, you're telling the system, I want to wait until a certain price in order to input my order into the system. So it's very different than the limit order, which says, I'm just going to input my order and I'm going to give you some limits that you can trade that. When you trade a stop order, what you're saying is, I only want to then input the order if the price gets to this level. And it kind of sounds like semantics, but there's some really important reasons why you'd want to use a stop order. So let's say that Bitcoin is trading at 60K. And then there's an upper price here and a lower price here. So let's say the lower price is 59,000 and the upper price is 61,000. Obviously in the market, it's going to be a lot tighter than that, but just for illustration purposes. So the market price is at 60,000. And what you're going to say when you put a stop order in is, at 59,000, I want you to input an order. Why would you do this? Well, let's say you want some insurance on the downside, right? So you entered into an order at 60,000 and you say, look, I'm happy to hold, but if the price gets to 59,000, it's a little bit low for me and I want to stop my losses. So we call this a stop loss order, or an SL. So if the price falls to a certain level, then you need to sell whatever it is that I have. Why would you want to do this? Why would you not just put a limit order in? Well, if you just put a limit order in to sell with a limit price of 59, the system is going to sell straight away because the current price is 60K and you're saying, I have a limit order here. I want to sell straight away as long as the price is above 59. So if you put a limit order in at 59, it's going to sell you basically at 60, right? But that's not what we want to do. With a stop loss, what we say is if and then. So if the price gets to 59, then you can enter a sell order for me to stop my losses. So this is called a stop loss order. You can put a stop market or a stop limit. So a stop market would be if the price falls to 59, then enter a market order just to sell. Doesn't matter what price it is. You can put a limit order in to say, if the price falls to 59, then enter a limit order and only sell at 59. Or you could choose any price that you want. So it's very different than a limit order. A limit order is going to sell you up at a higher price, and a stop loss right here, if then enter an order. Same on the upside as well. So if you wanted to sell at a higher price, then you could input a limit order. That's no issues, right? So you could say, if the price gets to 61, sell me with a limit order. The price isn't at 61 right now, so it's not going to sell you out at 60 because your limit price is 61, so that would work. But if you want to sell at a higher price, you could say, if the price gets to 61, then enter a limit order or a market order for me. It's different than just a limit order, right? So if the price gets to 61, then we can go and enter either a limit or a market order. And this is called a take profit. So you're saying if the price gets to a certain level, then you can go and enter either a limit or a market order for me. Back on Binance, and we can come over to the right-hand side to input our orders. We can see we've got a stop limit order coming in now. We'll just take myself away right here. So the stop order right here, this is the price at which the system will input the order for us. So the price of Bitcoin right now is 61. So let's do a stop loss order. So let's say you bought in at 61 and you can say at 59,000, enter a limit order for me with a lower band of 58,900. What you're saying is, if the price gets to 59,000, enter a limit sell order, and the lowest price I want to take is this limit price, which is 58,900. So that gives you a little bit of downside to say, hey, look, if the price is falling off that's my limit, right? That's the lowest amount that I want to take. Now that's very different than a limit order. If we put a limit order in right now at 58.9 or 59, it would trade straight away because the price is above. So that is how you do a stop loss on the sell side. On the sell side above, we can also do that. So 61 is the price right now. Let's say 63,000 we want to sell. You can say at 63, enter a sell order for me, and the limit price is 62,900. So what you're saying is put that order in for me with a limit. I've got a little bit of downside there. If the price is actually 63, then I can take a little bit lower. Or you can say, actually, my price is 70,000. So when the price gets to 63, put a limit order in for me at 70,000. You won't trade, but the system will do that. You can do it on the buy side as well. If you want to trade breakouts, you can say when the price gets to 70K, then enter an order for me. And, I'm happy to pay 72,000 or whatever it is. You might want to trade a breakout because it's a very even number. Prices often break out and break through those even numbers, so you can do that. Or you can even say, when the price gets to 50K, if there's a sell-off, then you can buy me some at 50K, put in your amount here, and that will all go through for you. So slightly different than limit orders. Stop loss orders definitely have their place. Candlesticks are for traders. I use them every single day for 6 years or more. They tell you about the trade, buyers, sellers. If a client rings in and gives me an order, I need to be able to essentially tell them what's happening in the market. And the way that I do that is by looking at candlesticks. They actually tell me a few different things, right? They are the gold standard that professionals will use to actually see where the market is, where the trade is, who is winning, buyers or sellers. I need them to tell me about the actual trade in the market as it stands right now. We can also use them for some different things as well, trend analysis, and over time, we can definitely use them to get a better feel of the market. But we don't use line charts, okay, because they suck. When you go to any kind of consumer-based app, you will see a line chart. Yep, okay, that tells you what the price was yesterday, which is fantastic, and it tells you nothing about the actual trade, the actual fight between buyers and sellers in an asset. When we trade, we need data, okay? We need to know what the high is that people paid. We need to know what the low is that people paid or sold out. This is actually known as the open high, low close, right? The OHLC, open high, low close. So immediately, you have more information. You have the opening price. Now this is for a time period, right? So let's say the time period, could be a minute, could be 5 minutes, could be 4 hours, could be 1 day, could be 1 week, could be 1 year. You can choose that, doesn't matter. For that time period, what is the opening price? What is the closing price? And what is the high and low price in that time period? So immediately, when you have a line chart, you just have a dot. Okay, it doesn't tell you anything. With a candlestick, you have data, you have trading data, and you can see the fight between buyers and sellers. So let's actually put a candlestick together. So we have an open, high, low close. What does that actually mean? You can see in the top right, is it, of the screen, that is candles. So we're going to draw these now. So I'm actually going to draw an up candle, and obviously that's denoted in green. You can change the color in your trading software if you'd like, but obviously we have an opening price, right? So let's say it's 12 o'clock. At 12 o'clock, what is the opening price for the candlestick? What is the opening price for the asset? Just take Bitcoin against US dollar. That comes in here. Okay, so we just draw a line like that. That is the opening price. Let's say, 51, 2, 3, 4. Okay. What is the closing price? Well, we don't know that. We're going to have to wait. Let's say we've got an hour candlestick, so 12 till 1. So what happens to the price during an hour? It's going to change. So it starts at this opening price. Let's say it comes down here, and then it trades back up a bit, and then it trades down a bit, and then it trades up a bit, and it trades down a bit again, and up a bit again. So let's say at 12:45, it actually reaches all the way up here. That is the high, and of course down here at the bottom is the low. At 1 o'clock, the candlestick has to close. Okay, that's the time that we're looking at, so that hour. From the high price, the candle actually finished a little bit lower than the high price, so it finished around here. So now we have the close. So we have the open, the high, the low, and the close. the close is higher than the open. So the price moved up during this time period. And so we just close off the candlestick and color this in green. So what do we have? We now have a candle, but we also know where the open, high, close and the low price, let's say this was, 52, 1, 3, 4, whatever it is. And then this is obviously a little bit higher. This is obviously a little bit lower, but we have the open and the close. The difference between the open and the close is colored in, and the block in the candle is made. Now, another thing to know is that this is called the candle. This is called the wick, okay? Or this is called the body. You can call it the body of the candle, okay? And these are the wicks. So just like a candle, you have the open, high, low, close. You have the real body, and you have the wicks as well. These are sometimes called shadows as well. Lower shadow, upper shadow, whatever you want to call it. But essentially they are quite a simple way to just draw 4 bits of trading data in one piece of the chart. Let's see these in action then. So we're going to go to Binance and see these. So we can see the candlesticks right here, and we can see some open, highs, lows, and closes. So for every time period, and you can change that in the chart. So when you are looking at a chart right here, I'm on the day period now. So each candlestick is a day, but I can change that to 4 hours. You can see that the chart will change. Now each candlestick represents 4 hours of time instead of 1 day of time. And they're going to be different, right? They're going to be different sizes because the prices in a 4-hour time period are definitely different to the price changes in an hour or a day period. So we can see these are 4-hour candles right here. So we can see the open, high, low, close of each. From a really basic point of view, we can definitely see the open of a candle and then the lower portion, the lower wick. And in this 4-hour period or whatever it is, it actually went up all the way to here. So a very good period for that. Now, you might be thinking, well, what do these actually mean? How can we analyze these further? There are, of course, ways that we can use different patterns and everything. We'll get onto that in different videos. So before we end this part of the course, we'll just look at how candles are actually put together. So as we can see right here, you have an open, whatever price that may be for a time period. We have a low, we have a high right here, and then we have a closing price, and that is put in a color, green in this case, because the close is above the open. But of course, we might have down periods as well. So we can see the open price right here, and we have a high for the period, and then we have a low for the period, and then the closing price is below the open price, and so you will color that in red. This is a typical candlestick chart, but there are different types of charts that we can use as well that use the same sort of drawing. And this is called Heikin Aisha or Asher, probably Aishi if you're Japanese. I speak Chinese, so you pronounce it differently. But this type of chart we can actually see on something like TradingView. So you can come up here to the candles. You can choose candles, but you can also choose this type as well. And you'll see it change. So it just changes a little bit. So what's actually happening here? Why is it changing? Okay, let's come back to the slides, and we can see that this type of chart uses the candlestick method, but it uses different data. So instead of just looking at the open, high, low, close for a specific time period, what it does is actually the open is the midpoint or the mid price of the last candle. That's very, very different to just saying at 12 o'clock, what is the price? That's the open price. This is saying basically the midpoint of the last candle, that's what we're going to use as our opening price. And then the closing price is actually the average of the current time period. Very, very different to saying what is just the basic open, high, low, close. This is giving you more of an average price over 2 time periods. And this is more appropriate for trend trading, or it at least gives you slightly more information about a longer term trend. So instead of just giving you 1 time period, it's essentially giving you a trend over 2 time periods. So it basically flattens out some of the movements. Why would you want to use this? I think for sure if you're looking just at a longer term trend, so you're trying to flatten out price movements, you're trying to flatten out maybe outliers in terms of the data, then you would want to use this one. You can do that. I personally just use the typical candles. You can see how it changes because this gives me the real data of what's happening in the market, the real data between buyers and sellers. The hammer candlestick pattern is a bullish reversal pattern. Let me explain what I mean by that. during a time period, what happens is, you get an open, and then you get a low down here, and then you get basically sellers coming all the way down, forcing it down to here. But then during the time period, buyers come back in, push it all the way up, and the price kind of closes around here, and it prints like this, and then that's kind of forming kind of what we would know as like Thor's hammer. So we can think of it like that. Thor's hammer's coming in powerful. So let's see what that looks like if it was perfect, and it doesn't look like this in real life. But what we have right here is a green candlestick. So we know that the close is above the open. So we know that this would be the open right here. And then during the time period, we can see this huge wick down below the open. So we know that during the time period, essentially what's happened is that sellers have come in and forced the price right down. But we know because it's a green candlestick, the close is higher than the open. So what's happened is that during this time period, buyers have come in and just forced the price up, right? So we know that kind of at the start of the time period, sellers came in and forced it down, but the end of the time period, buyers have eventually come in and forced this price right back up, and it actually finishes right here. So the close is above the open, meaning it's a very bullish candlestick from a very big sell-off. What we use candlesticks for is trying to predict the next candlestick. So if you have buyers coming in towards the end of a time period, towards the end of a candlestick, pushing the price right up from the lows and getting the close even higher than the open, then we could suggest that that could spill over into the next time period. And that's what happens here. So when you're looking at a hammer pattern, you're thinking this is a bullish reversal pattern. The sell-off is finished. Buyers are coming in. Price is coming up. So let's try and see this in the real world. And it will never look like that in the real world. But we can see a couple of different times where a sort of hammer is shown to us. So we can definitely see right here, this is a sort of hammer. So we can see that during the time period, sellers forced the price right down to here, but during the time period, also buyers came in, just forced the price right up to actually close higher. Did that spill over into the next time period? Yes, it did in this case. Buyers still came in, forced the price up even more. So that's essentially what a hammer is. It is a bullish reversal pattern where sellers come in, force the price down, but towards the end of the time period, buyers come in, force it up, and that could spill over into the following candle or following time period. A shooting star is the complete and total opposite of a hammer pattern. It is a bearish strong reversal pattern. So you've got buyers coming in, pushing the price up, but during that time period, sellers come in and force it down. So what you have is essentially like a shooting star. So we have, the star right here, and then the tail kind of coming behind it. So it looks a little bit like a shooting star. This is what a perfect shooting star would look like. So again, what we have is kind of a run up here. And then what happens is it's a red candle. So we know that the close is below the open. So this would be the open right here that we can see. During the time period, buyers are forcing the price all the way up to this high position. But during the end of the time period, or towards the end, sellers are coming in and basically forcing this price all the way down to this low period, making what looks like a shooting star. This is bearish because it tells us that towards the end of the time period, sellers are winning and they've forced the price right down from those highs. And we could suggest that this may continue into different or future time periods, future candles, and that could suggest a little bit of a sell-off. Let's come to the chart and see if we can see a real world shooting star, and we can see that here. So in the real world, these perfect chart patterns don't play out, but we can see what would be considered a shooting star right here. So we have some choppy trading right now, and what we can see is a kind of a run up here, and then this is actually kind of like an equilibrium candlestick pattern, but we can see a kind of a buy up here to like a kind of new short-term high. We can see some kind of level here for the trade, right, where it can't really get above, and then the price tries to get above this, but it kind of gets rejected right here, and it kind of prints this kind of ugly looking shooting star. And that's kind of bearish. It's telling me that the price can't break through this kind of resistance level right here. So it prints this shooting star after a couple of good days, and it's a fairly bearish pattern where we may think, okay, buyers aren't winning here, and sellers kind of won that candle, and they may kind of force the price a little bit lower, and that is what happened. So a shooting star is when you have a run up, and then this kind of print of a high, but sellers win and bring it back down. And that could mean that over the next few candles, sellers may continue to win. A bullish engulfing is a great chart pattern to look for, especially if you're long. This may be as a result of some fundamental news, something that's happened, and people have just are rushing to buy this. So a bullish engulfing is when you get a down candle. So you have this down candle here, print, but then the next candle just engulfs it and it's bullish. So we obviously have a bullish side. So that would be the bullish engulfing. It's when the next candle just completely engulfs the previous bearish candle or the previous down candle. It can also result from a small up candle or a kind of neutral candle, but it's bullish to the upside and it completely engulfs the previous candle. We can see that here. So what happened is, we were getting this sell-off. And then what happens is you get this right here, which is a kind of bearish print. And it's fairly small, which means that the price may be starting to find some sort of equilibrium where buyers and sellers are sort of evening themselves out. And then after that, what you get is this huge print, this huge bullish engulfing, a big move to the upside. And this tells us that essentially that selling pressure has pretty much dried up for now, and that buyers are kind of outweighing sellers at this point, and they're having to, pay a slightly higher price. We can see that on the chart here, and Bitcoin, this is the Bitcoin price chart, and it's full of bullish engulfing. So what we can see here clearly is a bullish engulfing right down here at this low. So this was really the last low after China banned Bitcoin. And we can see that, the sellers are kind of winning and the charts are quite small. The candles are quite small. So this tells me that, maybe the kind of the big move to the downside is starting to come to an end. And when do we see this bullish engulfing? Right here. And that just so happens to be pretty much at the swing low for this time period. So the very low price. And then eventually, some sort of news comes out or some sort of sentiment turns and you just get this big bullish engulfing to the upside. The green candle is absolutely engulfing that previous candle, meaning that sentiment has absolutely definitely changed, and boom, we're going to get kind of more. Will that spill over into the next time periods? It did in this case, and we got a really good bull run up. So a bullish engulfing is great to look at, a kind of bullish reversal pattern, and it's a very strong indicator. The complete opposite to a bullish engulfing is a bearish engulfing, and it's exactly the same thing, just to the downside. So what you have is, an up candle, and it may not be a very strong print. So it may be kind of a very small candle, and then you just have this kind of huge down candle that engulfs the bullish candle. And this would also suggest a reversal in the price, but to the downside. So we can see what an absolutely perfect bearish engulfing looks like. You get this, these run-ups, and then eventually the price and the sentiment and the traders change and the sellers are going to take over. And then you get this big engulfing for this first candlestick. And of course, that may spill over into the next time period and the next candlestick. We can see it again on the Bitcoin chart, and it happened right here. We have this lovely run-up, this awesome run-up in the price over a couple of weeks. These candlesticks are day candlesticks, by the way, so 24 hours. A really lovely run up from a low at around 30, moving up much higher than that. And then you can just see this huge bearish engulfing. So we have this nice green print, and then bang, you have that big sell-off. Now, why does that happen? There may be some news that comes out, some FUD, something else. You don't usually get huge candlesticks normally unless there's some sort of news that forces people to reevaluate how they're valuing that asset. So here's this bearish engulfing, bang, and then that does follow, some kind of more slight moves to the downside over 10, 12 days like that. So, it just means that sellers are coming in and there may be some softening in prices over the coming periods. So bullish engulfing is good to watch out for, especially if you're looking to buy and go long over the long term. These bearish engulfings, bang, you get a week of kind of soft trade. Might be good to step in there if you're a buyer, but obviously everyone's going to be different. We can look for those to see where the bearish moves may be coming in the future. Single candle prints can't give us too much certainty. It's just one candle. So we look for chart patterns where we get confirmation on the wider chart. One of those confirmations that we can get is a double top. So this is over a longer time period. A double top is when the price essentially hits a wall to the upside, hits resistance twice. You can have a triple top as well. This is bearish because it means essentially what's happening is the price is moving up, but then it hits a wall. It hits resistance at a certain price where an amount of traders and sellers think, yeah, this price, I'm good selling here. And then what happens is the price kind of moves down again, and then, you know, it will meet kind of a support level down here, you know, sometimes called the neckline, but it kind of, you know, hits resistance, comes back. So people regroup, buyers regroup. You get this kind of support right here. Then they move again to the upside and think, yeah, we're buyers again. And you meet resistance once more at that same price, right? So you can see this right here is this resistance price. This is clearly a resistance price where you have an amount of sellers that come in and just say, happy to sell at this price. So what happens is that the price obviously falls off again from that. And if you have sellers in the market, especially if you're a buyer and you're thinking, oh, you're a seller right here. Okay, well, I'm a buyer, but I know you're a seller at this price. You know what? I'm just going to wait. I think you're a seller and I'm just going to wait and see if you take down. So you may say, okay, this is a bearish price, but if you're a buyer, this is what trading is all about. It's about games. It's about guessing where people are. And it's about saying, if you're a seller at this price, you may also be a seller at a lower price. And I may get some cheaper Bitcoin, Ethereum, whatever it is. So we may see this kind of move to the downside. So let's see that on the real chart and see how that would play out. What you can see here is essentially a triple top. And again, in real life, it doesn't print perfectly, but we can see, you know, a big move down here. So as a trader, you're thinking, okay, where's the price going to consolidate? And you get this big bullish engulfing here and you think, okay, the price might be moving up. You get a top right here and it kind of prints at this level. Then we see, you know, the price move back down. Buyers come in, force it back up to this level and it meets a top again. Sellers come in and force it down again. So then buyers also try for a third time to kind of really push up the price and it meets selling resistance once more and that price moves down. It doesn't usually happen a fourth time. It may do, but usually if you've tried 3 times to push through a price level, like at some point it either moves way through it or the buyers give up and say, you know what, you keep selling, I'm going to buy some at a lower price. And that's what happens. So bang, the price comes off and we actually get kind of 2 weeks, maybe 2.5 weeks or more of, you know, kind of softening prices. So that is really a top pattern. It can be bearish. It means that buyers aren't winning and pushing the price up. You might get a resistance level and the price might come down. That's bearish if you're already long, but if you're a buyer, you may use this to your advantage. A double bottom is the exact opposite of a double top. Could be bullish and it could mean that the price has big support at a certain level. So a double bottom is bullish. The price met support. And we can see the exact same thing here. So we have a price level where, you know, the price comes down to and it meets support at this level. So we'll move back up to this neckline and then we'll move back down and try and retest that bottom level. And it's sellers coming in and saying, I'm selling down at this level. Buyers are saying, thank you very much. I'm in the market. I'm buying like here. And we can see the price moves on. So there's 2 confirmations at that lower price where you're saying sellers just can't force the price any lower and buyers are lapping it up. So let's come to the chart and see how that plays out. And we can see actually a very short double bottom printed. So you can see for sure we have a bottom here, and this is definitely kind of lower in the range. We can see the last sort of print around this level is down here where you get this mini sell-off and then you get a kind of buying pressure pushing it up. And then we're seeing some prints lower right here. So we see this print, which is the lowest print for probably about 3 weeks or so. So we get a bounce off that and then sellers test it again. And we see the level again. We see that double bottom here. So that's the second bottom and buyers come in and step in again. Now it just so happens to coincide with this 99-day moving average, which is a longer moving average of prices. And it's a good indicator of kind of medium to long term where the prices are. So just so happens to coincide with that moving average where you come down, find support at this level, then sell off, find support again. That's the double bottom. And that's telling people, hey, buyers are here and they're buying that kind of area, and it may move up. Eventually they may move up, may move up, and that's exactly what happened. You got this huge rise to the upside where Bitcoin kind of hits a new time high. So that's the double bottom. It means that a support level is in and buyers may come in and push the price up further. An ascending wedge is a very bullish pattern, and it shows me that buyers are having to consistently pay higher prices for the asset that they want to trade. So the key of an ascending wedge is resistance and support. So what we can see is there is a resistance line right here that sellers are coming in and kind of keeping the price at, but you can see the support level is consistently having to rise higher. And that means that buyers, even at low prices, are having to consistently pay higher. So what you see is, you see a low print here, and the highs don't rise, they're just level. But when the swing lows come in, and a chart never just goes in a straight line. So what you'll see is these kind of moves up and then a move down, move up, move down. So it meets resistance at this price once, twice, and 3 times. So remember those double tops and double bottoms. So what we're seeing is a top and another top, and then we're saying, okay, is that going to be bearish? And it was bearish down here. So you would have won a short-term trade, but if we zoom out a bit and go to a longer time frame and actually see that the swing lows are getting higher and higher and higher, this is bullish. It's just like water flowing through a pipe, and it's just getting smaller and smaller, and eventually, boom, it has to burst, and everything goes to the upside. So really, we're seeing rising prices for support, and that level, that resistance, eventually having to be broken through because the support is getting higher and higher, that there is less supply, less and less selling supply over time. And that's why those lows are getting higher and higher. And eventually something has to break, something has to go. And usually with an ascending wedge, this is bullish. And eventually buyers or sellers just eventually step out the way and say, look, there's obviously buyers here, and boom, it goes up to the upside. So quite a rare chart to see this one, but it is a very nice bullish pattern. The complete opposite of an ascending wedge is a descending wedge. So exactly the same thing, but for the downside. We have swing highs and swing lows with everything. The highs right here, you can see are just coming down. You have lower highs, and there is usually a support level right here. So this is the wedge, called a descending triangle sometimes as well, but you have just lower highs. So during those swings, buyers push the price up, but you do meet a kind of floor here, like a support price. We can see that the highs are getting lower. So the kind of momentum to the upside, the exuberance to buy is just coming off a little bit each time. And that's obviously in a slightly longer term trend, a kind of way of saying the buying pressure is kind of drying up a little bit. And even though it's finding support right here, that buying pressure is just drying up, and it may actually break through that support level and then go lower. So lower highs is a bearish sign that the price could be breaking through a support level and going lower. So something to watch out for. We can come on to the concept then of higher highs and higher lows. A chart always swings about, but if the lows are consistently getting higher and the highs are consistently getting higher, it's obviously an uptrend, and it's very, very bullish. So higher highs and higher lows is a very bullish trend. So we always look at highs and lows. That's the important thing. So we can see that this low print, the next swing low, the next time the price has moved up and then back again, everything is in a state of flux. But the next low print is higher than the previous low print. Swing lows. So the swing lows are getting higher and the swing highs are getting higher. Now, of course, everything goes up and down. Nothing just goes in a straight line. So this is bullish, right? We expect a kind of swing high exuberance, a little bit of a sell-off, everyone kind of regroups, buyers come back in, bang, take it right up higher again, a higher high, and even during a sell-off, a higher low, super bullish. So let's come over to TradingView and we can see the Ethereum chart. This is January 2021. So we can see a lot of swing highs and higher highs, higher lows. So we get a big run up here, which is great. And then after a huge run up, you might think there's going to be a little bit of a sell-off, and that's what happens. So we have a print right here, which would be a swing low. So that's the low that we have in. We know that because after a couple of days, price moved up. So that would be our swing low. Then we're looking for the next high. If this is definitely an uptrend, the next high should print higher than the previous high, and that's exactly what happened. So we have a swing high right here, higher than the previous high, so it's a higher high. Then we get another swing and a pullback, and we get a low price. That low print is higher than the previous low, so it's a higher low. Then we get another print and about the same, but we get a kind of another pullback. This low is higher than the previous low. Still bullish, still an uptrend. Then we get a couple of days of trading, but then we get bang, we get a higher print here. So a higher high. This pullback is a higher low than that time. Higher high again, higher low. Then we get some kind of choppy trading, and what we can actually see from the wider trend is that actually this trend is still going. So even though, we get choppy trading, we get a higher high, we get a massive high print here. And even with this huge pullback, this is lower than these periods right here. So you can say, well, maybe the trend has broken down. It depends how long you're looking for. This generally is a much higher high than all of these kind of lows, much higher low than these lows here. So charting is difficult. It doesn't go perfectly. And what happened here was basically like a few days of kind of sideways trade where people were thinking, well, we're going to have to check ourselves here and see if this price is really for us and what's happening. You may get a bit of news right here and a kind of a sell-off, but the general trend for sure is that this low print is way higher than these. And the trend kind of, comes off here and levels off a little bit. But if we look at the general trend as well, this low print is still higher than this one. So it really depends when you're looking. You can trade mini charts and get some trends there, or you can kind of widen out a bit, look over various months and get trends there as well. I tend to look on longer trends, but we can see it for sure. You get higher highs, higher lows. That is the definition of an uptrend. The exact opposite of a bullish trend is a bearish trend with lower highs and lower lows. So that's what we want to watch out for. We have the low right here, then the move up, and then we have the move down to a lower low, and then the relief rally, dead cat bounce, whatever you want to call it, is just way lower, right? So this is the trend. We can see that moving down, definitely the trend there. So let's come and see that on TradingView. And we can see kind of a mini trend here is we have a print right here after a big high and a big swing high, good news coming out. We have that print, and then we have the sell-off happen here. So this would be a low printed right here. So around $1.30. Then you get kind of a relief rally, kind of twice. You get a double top here, which potentially is bearish. So you come up, you get the double top, and you think, okay, well, this is printed slightly higher than this one, so this could potentially be an uptrend. We get a higher high, and we think, okay, what's happening here? But we actually get a really bearish engulfing right here that tells us that essentially sellers may be coming in, and that's what happens. So we get the high printed. We then get kind of a swing low right here and a little bit of a relief rally, but we see that this high for sure is not as high as the previous high, so it's a lower high, right? So we get a high, a low, lower high, lower low. Then we get a huge hammer pattern, which is a potential bullish move. We get a bullish engulfing. That would confirm to me, if I was a short-term trader, that the price is going higher. I would have got in there and then rode that over the week and, made 10 cents. So, again, with charts, everything is relative in terms of the time that you trade. So if you're a short-term trader, you have more risk. Longer term, this chart is still in a massive uptrend. You just take a step back and look longer term. I'm just showing you here what a mini downtrend would be. A lower high, lower low, lower high, lower low. And then it reverses, but we do get, a print here for the high is, still lower as a high. So you actually get a lower low right here. Then we get the bullish engulfing, total reversal, massive move to the upside. So again, this shows you that when you trade charts and when you trade short term, massively risky. You're looking at, a mini trend within a wider trend. I personally look for wider trends. I look, over various months, look for those highs and lows rather than mini trends. I'm just showing you here. So if we zoom out, over the longer term, we can see that actually what's happening is just a much bigger uptrend. So we've actually got a high print, you know, a higher high, higher high. You know, these lows are kind of higher, apart from this print right here. Big consolidation, then move up. So it does matter what time frame that you're on, but for sure you can see these trends happening. Higher highs, higher highs, higher lows is uptrend. Lower highs, lower lows is a downtrend. Support and resistance show us key price levels, and they're really important when you trade so that we know those key areas that we can place our orders. So I want to come to what support and resistance is. Obviously, we can think by the words. Support is when there's a level of support for a price, and resistance is a price where it's probably quite hard to break through that. So that's exactly what that is. But when we trade, these areas are super important for traders to actually identify, and you can place your orders around that. So all that support and resistance are is key price levels in trade. Now, what is a key price level? Well, usually that can be around a round number. So we're going to look at the ADA price chart, and it just so happens that $1 is a really key price area of support, or was in the past anyway. And that usually happens, you'll get a big level of support around $1, like a round number, right? Like $100 or something. Big round number is usually good. You know, we are humans at the end of the day, and a price is just simply a reflection of what traders think. It isn't a perfect reflection of the actual value of an asset, and human beings like round numbers, and it is completely self-fulfilling this. So price will be sticky around these levels for sure. And what happens if you get $1 support is that you'll probably see that the trade actually slows down around $1 level. And if you're a buyer and you think, I want to buy at support, you probably won't get much at $1. You'll probably have to pay like $1, $1.05, $1.07, $1.10, something like that. It's not going to be perfect around $1. So you might see that for sure. And if you use stop losses and you want to trade with some stop losses, then for sure you might want to put your stop loss under $1 to give yourself some room for that stop loss as well. So this is where traders battle to win. Really important to know with support and resistance is that they have to be broken. Just like records, you know, at the Olympics, they're all made to be broken. And eventually traders just re-rate the asset. An asset is ever changing. The value of an asset is ever changing, hopefully to the upside as more value is given to the project or the business or whatever it is. So these areas of support and resistance are supposed to be broken. This is exactly what we mean by support and resistance. The support is to the downside, and it is a key price level where we look on a chart and see that support. So the support comes in at these levels, and you can see this buy right here is actually not at support. Very rarely do we get a perfect print at a support level. So if you're waiting to get in perfectly at support, let's say this, I don't know what asset this would be, but you know, let's say this is $1, right? And you're thinking, I'm just going to buy exactly at $1. You may not get many opportunities. It may come down a little bit, but then go back up. So that support and then resistance to the upside, we can very clearly see a price level here. This in the real world doesn't trade like this. So let's see what support and resistance actually look like on TradingView. So we can very clearly see there is a support level here, and it just happens to be around $1 for ADA. And you can see that very many times when there have been sell-offs, intraday sell-offs, big bits of news that have created sell-offs. And we can see a real strong level of support around this level. Now, around 80 cents or something, you can see a couple of days of trade for sure around this level where after this huge run up and a sell-off, you still get people saying, I'm happy to buy into this. And we can see one big sell-off here, but it gets rejected intraday. So the price is actually finished much higher, around 94 cents. So intraday moves are very, very important to look at. And where the actual day finishes, so where the print is, where the close is more important for me. As a trader, we would always trade based on closing prices. And when our clients came into us and said, you know, basically we want to use a broker because we want you to get us a good deal, we have to tell them that we've got a good deal. And the way that we do that is through the average price that we get. We call it potentially VWAP or something like that. You may be given instructions by the trader to beat the VWAP, which is the volume weighted price average, or beat the average closing price over a time period. So that is how a trader would trade these things. So what we're seeing as a trader is, for me, the closing price is important. Some people look at intraday prices. That's not important for me. See, things can happen intraday, but it's where the price closes that's important. That's the print that you get on the system, at least in the stock market. A little bit different for crypto. It trades 24/7. But we can see this print right here is around 95 cents. So let's call that a real dollar support level. Then you get another major sell-off. And again, 1, 2, 3, 4, about 4 prints. So about 4 closes, all above that dollar level. It's telling me that this dollar level is an area of support for sure. We get another sell-off. And again, you get like 1, 2, 3 days, 3 prints around that dollar level. Sellers are coming in. They are not forcing it below that dollar level. We then get another sell-off. Another sell-off at $1. Again, you get some closing prices, you get an intraday pull down, like a pullback, and then bang, buyers come in and just keep it above that dollar level. This is an absolute area of support, and you can see more intraday moves that are all coming down to around $1. Here, even during the huge sell-off, you have this dollar level. That is massive area of support. So for me as a trader, how do I use this? What I'm saying is, basically, dollar is my level, and I'm going to probably put in buys if you want to go long the asset. That is, if you're kind of a buyer over the long term, I'll probably put in some limit orders around $1 and just see what happens, because you can see that you get these big sell-offs in price, right? You get these big kind of drawdowns during moves of volatility and FUD and everything like that. And I would just be putting in some limit orders around $1, $1.10, $1.15. And what would have happened to me is that instead of kind of buying at all these prices up here and paying all these silly prices, I just would be patient and wait, and I'd get my ADA tokens at $1.10, $1.15, and I would just beat the market by 50% in terms of what I'm paying. Now, yeah, I might DCA in at these higher levels as well, because you may just pop off some trades, but if I'm saying to myself, I am a buyer of this, and I have conviction in buying, I'm just going to put in some fairly big limit orders at this support level, and I'm just going to wait for sell-offs and see what happens. I may get hit, I may not get hit, and I would have done pretty well, just buying in at these lower levels and having those limit orders. And, maybe I would have bought some at higher prices, and, I would have got an average price, but this would have been a great opportunity for me to reduce my average price, looking at support and resistance levels. So a key thing for traders to look for. Consolidation is what happens after a big move in the price. And the problem with huge price moves is they're kind of unpredictable, and they often happen and you can't really predict where the price will be, or if the price that it's trading at now is going to kind of be solid, or whether the price is going to come off. So what I look for, and a lot of other professional traders will look for, is consolidation in the price. Consolidation is just an area in the trade where there's kind of less volatility. And that tells me that buyers and sellers are kind of in equilibrium right now, and that the price is more reliable. And that's quite good for me, for sure, when I'm trading and looking to kind of dollar cost average into a project or into an investment. So consolidation comes after huge price swings. It's very difficult to trade very big price swings, because what tends to happen, especially to the upside, is you'll get a breakthrough an all-time high, or breakthrough a level of resistance. And then sometimes what happens is kind of a pullback. The price will come off of those highs, and the euphoria will kind of drip away a bit. And that's when I like to get in, rather than, trading on FOMO. I see a lot of retail traders trade on FOMO. I've got to get in, whoosh. Then they get their price printed here, and then the price comes off a bit and consolidates, and then they get kind of the FUD coming in, and they think, oh, that was a bad trade, right? So I exercise a lot of patience in trading, and I understand that, these assets are going to be around longer than I'm alive. And so I just have huge patience here to say, I'm going to be patient. I'm actually going to see where the trade consolidates. And that's what I do. That's how I would go into something over the long term. This is not for trading. Trading's different. This is really for trying just to get a solid price for the assets I'm buying over the long term. So this is a strong area of trade. And then what happens after a consolidation, after you get a good consolidation, the price will usually break out from there. So we can see this in action. So this is exactly what a consolidation period would look like. These for sure are consolidation periods. And then obviously in between those consolidation periods, you may have moves in the price. So, could you trade during these areas? Yes, absolutely. And, if you think, this is in an uptrend and I'm just going to get in for this uptrend, then that would be great. I would say that, what I would look for is maybe to trade in these consolidation patterns. This would be a good price to get in at. And I wouldn't actually mind getting in at this price either and actually trading this consolidation a little bit more and saying, I'm happy to kind of pick up these swing lows. That would be an area where I would say, what, there is a lot of support around this level and I'm happy to kind of get in here. During these periods, you get this volatility and we don't really know what's going to happen. So there's that you could just trade on the consolidation levels, or you could just trade, every month I'm just going to put in an order. So August, September, October, November, December right here. But you can see that during this kind of up period, December isn't really any different to these anyway. And we don't know where the price is going to finish during these up periods. With volatility to the upside, it will also may come down. So consolidation is something I like to look for, but it's not the be all and end all. For sure, you can just dollar cost average and say, I'm just going to buy in August and September, and I don't really care. But if you're looking at charts and you're looking, where is the price going to go from here? When it's in an uptrend, when it's doing this, it's almost impossible to actually try and predict where the price is going to go, where the uptrend is going to finish, if you'll get a pullback in the price. But consolidation patterns are great to look for to say, yes, the price is finding a lot of support and resistance around this price. So obviously this is a key price level. We can see something like that on the chart right now. So this is the Bitcoin US dollar chart. And from a long time ago, I mean, we get a consolidation pattern right here. So this is what I would call a consolidation. So we're getting a sell-off and then we get consolidation. And this would kind of tell me that maybe we are in an area where the price can reverse and a new trend can start. So consolidation comes after kind of a sell-off or either a sell-off or a move to the upside, and then you get consolidation at a price. And this is when we say, what's going to happen next? When you are in the midst of a run, obviously the run is, okay, it's to the upside, it's to the downside, and we know that's happening, but we don't really know where the price levels are. We don't know where they're going to finish and stop. So this consolidation period tells us, where we say, okay, we've got this consolidation. This is obviously a key price level. So when we're looking at charts as well, in the future, if you have Bitcoin or you have assets and you think there's a sell-off coming, then we can look at these areas of consolidation and actually try and pick them out and say, if there is a sell-off coming, essentially the sell-off may bring the price down to a previous level of consolidation, and this will trade. It's self-fulfilling. So we can look for areas of consolidation as key areas for trade. So if you're in Bitcoin and you see a sell-off coming, you can look back in the chart and say, that is a previous area of consolidation. That is possibly where the price may go. And then you can put some limit orders in and make some trades accordingly if you want to continue buying and picking up Bitcoin like that. So this works for any chart. Consolidation is a key area of trade that we can use as areas that the chart may go in the future, depending if it's a sell-off or if it's to the upside. There may be areas of consolidation to the upside that we may say the price may go there, consolidate around there again, and then from there move up or down dependent on what's happening in the news at that point. It is incredible how often, almost always, that the price of an asset trades around its moving averages. And again, we're humans and this is self-fulfilling. So what is a moving average and why are they important? One of the first things I ever learned as a trader was moving averages and how to use them in your trade. The price of an asset trades around these like a magnet, honestly. It is incredible to see, and we can see that on the real chart, but a moving average is obviously a moving average of the price. So instead of just looking at one price on one day and plotting them each day, we can take a moving average of prices over a certain time period, and that will show us so much detail. It is crazy how often prices follow these moving averages. So what I would say is that a moving average over 20 to 50 periods is short term. So you can also use a 7-day moving average. So moving averages are done over periods. So if you're looking at a chart, a candlestick chart where each candle is 1 day, then you'll be looking at a 1-day moving average. If the candlestick that you're using is, a 5-minute candlestick, a 10-minute candlestick, whatever it may be, then it will take the moving average of 20 of those periods. So you can say a 20-day moving average or a 20-period moving average, and you're looking at, a one-day candle or a 10-minute candle or whatever. So over 20 to 50 periods, I would consider short term. Obviously, anything under 20 periods is also short term. 50 to 100 is a medium term moving average, and 200 would show a long-term trend. And depending on who you are as an investor, you may want to look at different types of moving averages. These are for traders, I would say, and then longer is for investors. So we can see that. And moving averages often show us support and resistance. It is crazy how often prices move. So what I'm going to do is just show you how a kind of moving average is made, right? So let's take a 5-day. So we know that each candlestick is going to be a day, okay? But it can be a period. So if you have 5-minute candlesticks, this would be a 5-period moving average. So the way that this would be done is that you have prices, right? So we have 25, and then the next day, okay, this is the closing price. So $25, $26. We then have $25 again on the print. We then have $24. And then we then have $28. Okay, so these are the prices: 25, 26, 25, 24, and 28. What you have to do then is divide all of those by the number of days or the number of periods. So in this case, we're dividing that by 5, and that gets 25.6. Okay, so the average price over those 5 days is 25.6, and that is essentially the kind of line that will be printed, right? 25.6. Now the previous line may have been lower, and so what you'll get is obviously that plotted and then a line drawn between them, and that's the moving average, and it smooths out all of the moves. Obviously the next day what would happen is that essentially, let's say this is $26 right here. Okay, so what would happen is that this one gets cancelled out, and then you just move on the average. That's why it's known as a moving average. So we can see that here, and the way that you choose moving averages is up at the top of any trading system. So if you have TradingView or Binance, KuCoin, whatever it may be, just up in the top of the chart, you will get these moving averages. And yeah, you can go to settings right here, just change them. So really easily, you can see the MA, this is the simple moving average right here. So simple moving average is what I just showed you. So you have those days or periods, and then you just put the new one in, take the old one out. You can change them all. How many periods do you want to have as that moving average? Binance give me 7, 25, and 99 as standard. So 7-day, I would not personally use with investing. It just doesn't tell me much. Like, I know what a 7-day moving average is. Doesn't tell me much over the long term where prices are. But if you're a trader, you might want to use this. So we get a 25, which is kind of like a medium, and then 99, which would be medium to long. You may want to add another one, like a 200-day. So let's go and put that in. 200, and I'm going to move that to probably white or gray. So we can do that, make it white, make it stand out. Yeah, so that's fine, and save that. That will be put on the chart for me. So here we are. And we can see essentially, you can just see how the price is following this 7-day moving average. It's crazy. So the first thing is we see this green one, which is the 99-day moving average. So a slightly longer term trend. You can see that the price bounces off of this moving average line. So traders are coming in here and saying, we're going to buy the price off of that 99-day moving average. So the longer term trend is good. When you have an uptrend, you're always looking for the price to be above the moving average and bouncing off the moving average. That's an uptrend. And if it was in a downtrend, so let's see if we can have a downtrend here. So what we would see is obviously the price moving below these moving averages, right? So the moving average in this downtrend, as you can see, the 7-day moving average is like a cap to the price. The price actually doesn't get through the moving average. So the moving average here is really acting like a barrier, and that is to the downside, right? So all of the candles are printing below the moving average, and obviously the longer moving averages, as you can see here, so we've got the 25, 99 and the 200, the price is also below those. So we would say it's in a little bit of a downtrend here. The prices are below the moving averages, meaning that the prices are lower than previous. So that is a downtrend. So what we can also see, bullish moves is when the price actually moves up, and you can see moving averages print and crossover. So this is known as a bullish crossover, when you get a shorter term moving average moving through upwards through a longer term moving average. So that's a bullish crossover. Obviously what that's saying is short term, the prices are moving back up through the longer term moving averages. So that would be considered a bullish move. So we can see that right here, where the 7-day moves to the 28-day or the 25-day. So we see that 7-day moving to the upside. It's potentially a bullish sign. And what we can see here is, yes, that longer term moving average, absolutely, it bounced off of that. And then you can see this 7-day moving average right here, and the price just follows it. Now, obviously this follows the price, right? Because it's a moving average of the prices, but it's amazing how you can see that price comes up and just kind of consolidates a little bit over a couple of days towards this level, and then moves up again, and then consolidates a little bit and moves through back to the 7-day moving average, then moves up again, and again moves back to that 7-day moving average. You get a massive rise up, and then a few days of consolidation back to that moving average. So this will eventually, find resistance and move back, maybe possibly down through that 7-day moving average. Everything is in flux and changes, but it is amazing how often a price will really track and find support and resistance from moving averages. I always try to go a little bit longer with my moving averages as an investor, 99 days, seeing the longer term trends. But for sure, when you're trading and you're seeing this, moving averages are absolutely key levels of trade to trade off. So we can see here again, this purple line, huge here, huge support here during this uptrend. So we can definitely see those moving averages really play out over time. Really important to have these on your charts. So pick 3 moving averages that you might want to see. I'd pick a shorter term, just to see maybe a medium term, and then a longer term, like 100 or a 200-day moving average, to see the longer term trends. And then we see the shorter term trends play out. And there are key levels. The price often gets attracted to the lines and the levels as areas of support and resistance. So we can use that as levels that we might want to put our trades in at. Trend lines are something that we can draw on the chart to really give us some visuals of where trade might go in the future and some key levels that we may want to trade at. So how we draw trend lines really, and these are very different to support and resistance lines. So trend lines specifically follow a trend. So they will be kind of angled on the chart. So what we need at least 2 or 3 data points to connect. And the way that we connect these, the way that I connect these anyway, is by matching up closing prices. So I'll show you that on the chart. But we need those data points connected to the line to actually make that trend. And with everything here, we have to kind of give everything a little bit of room. Charts in the real world are not perfect. So we have to give kind of areas of trade rather than specific levels of trade, because in the real world it just doesn't trade like that. So what we want to see really is that the more times that we can kind of have touches onto our trend line, the stronger that trend is. So that's something we'll look at. For an uptrend, when prices are moving up, you want to draw your line below as a support level. During a downtrend, then your line will be above the chart as a kind of resistance level. So that's how that works out. You can use either the wick or the body of a candlestick to draw your trend. I personally use the body and closing prices. So when I'm looking at a day chart, I want to know the closing price. Cryptocurrencies don't have a closing price as such because they trade 24/7. A little bit different, but there will be a point in the day when it has to close, whatever that price is, and that's the one I look at. So yes, trends always break. So you cannot predict the future with this, just like all technical analysis. What we're going to do then is come to the Ethereum chart. We can come over to these drawing tools right here. So I'm just very simply going to draw a trend line. So that's this kind of line here. So what we want to look for is really a couple of different areas and swing highs and swing lows where we can draw this trend. Now, we can also see the moving average on here, and it's a 200-day moving average, and that's what I like to use as a kind of long-term uptrend marker. And to be totally honest, we don't need to draw a trend line on here because the 200 days is doing it for us. And like I said in the moving averages video, that's exactly what happens almost all of the time. It's crazy how much this works. But as a trend line, very simply, you just want to go from one point to another point. So we can see that we are absolutely kind of matching up these points here. And of course, you want to draw it into the future. So that's what we can see. And we'll just do that there. And then we'll just kind of take this down a little bit like this. So what we have really is kind of 2 data points. Just put that onto the body right here. We have 2 data points, and I would say they're quite strong data points. We have quite a strong sell-off here, and it met a big level of support here. And we also have a very big, strong sell-off here, and it met a lot of support here. And what that tells me is that the uptrend continued. Remember, throughout of all of these videos that we're looking at, essentially we're looking at lows and highs, swing highs and swing lows, and where the price goes. So, you know, what we're seeing here is a clear uptrend where the next swing low is continuing a very clear pattern to the upside. So what would I do here? Well, I'm not sure if this is an all-time high for Ethereum or what's going on here, but I typically don't want to buy at these levels above this trend line, right? So I don't really want to be paying here. I don't really want to be paying here. I want to try and time my entries when you get those pullbacks, and the pullbacks always happen, right? Now, sometimes, yes, you do get these big moves up to the upside and kind of a new all-time high, and that's great. But obviously, I want to make most of my buying decisions when really the hype isn't there. And it's difficult because these are new assets and these are just getting re-rated all of the time and moving up. And so, you know, I feel short a lot of the time as well. You know, I feel short of Bitcoin, even though I'm not short Bitcoin. I'm long, very long Bitcoin. I feel short. So sometimes I think, should I kind of buy at these levels and just dollar cost average in? You know, you can have that strategy. But definitely when I see these pullbacks occur or these consolidation events occur, so I can see a consolidation event here, I might have gone in there and thought, you know what, that's fine. And, you know, it's not too much of a downside to that trend line. But at these trend lines, when the price does hit these, that's an area for me to say, will the price bounce off of here? Now, sometimes trends are broken and it moves to the downside. So that's something to watch out for. You know, maybe you actually want to see the price come off to this level and actually say, you know what, that is, I'm just going to wait and see what happens with the price and see if it does bounce off of this or does go below this. But this is definitely a trend right here. So what I would expect is to see, you know, the price at least move kind of to this level. Now, what we're seeing really in the Ethereum price is a massive bullish move. So you're seeing the price really move away from this trend line a lot. Now, what this tells me is that the probability of it moving back may be quite low, and what we may be in for is just a re-rating and a new trend line coming. So trend lines are good to see, they're good as a guide, but they're broken all the time, and you certainly can't rely on them 100% of the time. So we have to use the trend lines plus the moving averages to try and get some areas of trade. And trade usually, not always, but usually does come back to some sort of level. And you can see this trend line right here. You could have drawn it. So let's draw another one. 1, 2, 3, 4 lines right here. That's like a mini trend. So that's a shorter term trend. Or, you can either go right here and try and connect those two. So that would have been a low and a low right here. So what we're seeing really is important areas of trade. So that could have been an area of consolidation here where we get some levels and then trying to match that up with another area. But you can see that essentially trend lines are good as a guide, but really they can be drawn in different ways, especially if you're looking at different time frames as well. So they're good as a guide. You can put them on and you can see areas and levels where you think, yes, the trade might come back here. So if I was looking to buy into Ethereum right now, I would have to obviously look for a longer and shorter term trend, where I can say these are potential price levels where the price may go to. And it's just a better way of trading, rather than saying, wow, the price of Ethereum's up, I'm just going to go and buy some. And then you're kind of buying in at these higher levels all the time, which is definitely not the areas where we want to buy most of our assets at, right? So these highs right here, where retail gets in on FOMO, these are the areas where I personally just pull back a little bit and say, I don't really want to buy too much here. I'm happy consolidation or the moving averages or the trend lines where you get those pullbacks. And I look for those pullbacks to maybe go in a little bit stronger at those times. Very difficult when assets are getting re-rated and constantly kind of hitting new highs. But this is just a way to try and get a better average price for our trades. Average true range is a fantastic indicator that I use a lot. I think I've talked about this in other videos, where you can use average true range, or ATR, as your stop loss. Average true range tells you how volatile something is. What is the average range of the price on any given period? And this basically moves through to volatility. So how volatile is an asset? It measures the volatility and change of volatility over time. And what I do is use ATR to tell me what is the kind of max one-day move that is potentially going to happen for the price of an asset that I'm trading. And this is typically based on 14 periods, but you can change this. Like I said here, it's useful for stop losses, triggers, and other types of signal that you can use as well. I think it's a great metric, and I do use it all the time. So we'll come over to the trading screen, and then we can come over to indicators and ATR, average true range. So what it's going to tell me, I'm just going to try and make this a little bit more bold so you can see it, is, and you can see the length, right? 14. So like I said, it's based on 14 periods, and obviously, you know, the period is whatever that may be for what you're looking at, right? So let's just make it here and press OK. So the average true range, now what you can see is essentially as the price is consolidating, right? So when a price consolidates, it doesn't move a lot. And so obviously the volatility is going down, right? High price movements, large price movements, high volatility, no price movements, less volatility. And this is exactly what's happening. So you can see the very sharp move down that we had was obviously an increase in volatility. And so the ATR goes up. We have a consolidation period and the ATR goes down. Obviously, it's showing me very quickly that the average true range volatility is reducing. So you can use this in a few ways. The first one is to take a stop loss. So let's say I was trading Ethereum right now. I think this might be the Bitcoin chart. Doesn't really matter, but Bitcoin, yeah. So let's say we want to go long here. Where do I put my stop loss? Well, like we've seen in other videos, we can look for areas of value and places on the chart. So you can maybe have a level where the chart traded before. But there's another way you can do things, and that is with ATR, and say, what is at the current time the biggest possible move or the volatility of the asset? And this actually gives us really easily a figure in dollars, because we're quoting Bitcoin in dollars right now, of the move. So the biggest one-day move right now is, you can see it's around about $2,000. So you can possibly set your stop loss if you're going long, if you're going into a short-term trade here and you're thinking, it's consolidating, I think we're going to move higher. Where's my stop loss? You can put it $2,000 lower. Simple, because that's kind of the biggest one-day move. So if you got it wrong, then obviously 2,000 can be a stop loss. That's kind of the biggest move, right? You'd set it just below that because obviously the volatility might increase a little bit. But it just shows you, where your stop loss might be. Another way to think of this is a signal. So usually when the price consolidates, and we've had a very long period of consolidation right here with ATR, you can see how the price is level, ATR is moving down. So this is called a divergence, right? So you're looking at a divergence here. Is the volatility relatively low or high? I would say that the volatility compared to the last year and a half is coming towards the low side, right? We are seeing the volatility come down a lot. So if it were to revert to what we've seen over the past year and a half, the volatility would kind of go up and increase again, right? It would be somewhere around, kind of 3,000. So we could put this on the chart and say, if the volatility is to go up and kind of revert to something more normal, we might actually see some moves here. This would be a signal to say, maybe this is a good time to put in a bet because we're consolidating and we might have a strong move, short-term day trade to the upside if you're a bull. If you're looking at the fundamentals and you're thinking, yeah, probably not, right? Then you might obviously want to go short and have that stop loss above $2,000 above, right? So ATR is a great metric. There are other ways that you can look at volatility. You can look at options volatility, implied volatility of options, because the volatility is implied based on the price that the options are trading at. So you can look that up. Option implied volatility for any asset. Bitcoin is the same, but a quick way to do it on the chart is by using ATR, which I think is a great metric. MACD is another metric that I use fairly often. I'll have a look at it and see what it's telling me. Like every single metric, I don't use it specifically to trade, but it is a tool that you can use to say, hey, like, what's the MACD right now? Is it kind of telling me what's up, or is it diverging? Is it telling me that it's not a great time to get in? The MACD is short for moving average convergence divergence. If we break that down, it's moving average. So moving average is, very great to use in many different respects. What is the convergence or divergence of those moving averages? So the way that the MACD is calculated is you take the 26 period EMA, you minus the 12 period EMA, and then you get a signal. The MACD, and then the signal is actually a 9 period EMA of the MACD, right? So it's a moving average of another moving average, which is the MACD. What it's trying to tell me is, it's technically known as a momentum oscillator. It's telling me where the momentum is, right? Because you're taking a longer term moving average and you're comparing that to a shorter term moving average. In this respect, it's actually a moving average of the other two moving averages. Makes it more complex, but it is a good indicator to use. I've got it on the chart here. Come to indicators, type in MACD. I've just set the colors up already because it's for some reason they're just always awful. But you have the histogram in the middle. The histogram is a histogram of the convergence or divergence of the moving averages. So it doesn't give you any more data, but it just gives you it in a histogram, so a bar chart rather than the lines. And then you have the MACD line in red and the yellow signal line. And what you want to be seeing right now is really the MACD line passing through the signal. So the way that we know that a move is bullish is when the MACD line passes up through the signal line. That is telling me that the moving average of the MACD line is obviously showing me a divergence away from the other moving average, right? So it's a momentum oscillator. It's telling me where the momentum is. If the MACD is moving up through the signal line, that is obviously bullish, right? It's telling me that the momentum has changed and we're getting kind of a bullish crossover, as it would be called. Obviously, when it moves down through, that's a bearish signal. It tells me that the momentum has changed into a bearish, momentum versus the signal line, right? And you also have to put in where the lines are in relation to previous, right? So if they're down in this bottom half, then we would probably look at the price to be kind of down from highs, more in bearish territory. Because the averages are down, and when the MACD and signal lines are very high, the price itself has probably gone through some sort of bullish run, and you can definitely see that on the chart, right? So we have the price right here has obviously been very bullish. Bullish move here. The price is up. During this down move, the price is below that kind of midway point. So that tells you. Now, what you can do is either trade where the lines, the MACD and the signal line are below the midline, and then you want to kind of trade them up into the middle line, or you can trade them from the middle line up towards the top. That's two areas of, bullish trade. Or you can do it from the top down to the middle line, or from the middle line down to the bottom, or you could just have it kind of somewhere in the top moving through the middle line, and that's when you trade. So different kind of formations to trade there. But I use this as part of another, all of the kind of things that I will look at. So the MACD is telling me really here, you can see the MACD is kind of crossing through, right? So we've got an initial bullish crossover right here. So maybe the momentum's starting to change a little bit. So we had a massive sell-off, as you can see here, and then a couple of days of choppy trade. Obviously, the sell-off has stopped, so the momentum has changed, right? If you have perfect downward momentum, this would always be down at the very bottom. If you have a sell-off and then a consolidation, the momentum has changed from down to sideways, and you see the momentum's changed, right? So it's telling me how the momentum is oscillating. That is a trade signal. When you say, oh, okay, well, I might want to go long here when the MACD passes through. That's my signal. We can see it chops around again, and you can see as the price moves down, obviously it comes off of this midline, so the bullish kind of move didn't come about. It got rejected down here, but then you can see the MACD passes back through the signal line and back through the midline. It's kind of like a double confirmation of a bullish momentum that's oscillating from the previous momentum. So that might be a signal for you to go and trade, and then you can ride that move up until maybe the MACD starts coming off, meeting the signal line again, and that is telling you that the momentum has changed once more. We've had that up move here, that momentum has changed, now the momentum's coming to an end, and that move is possibly coming to an end. And what you saw is that we had this up move, and then we had a sideways move, right? Which is a consolidation there. Obviously, the price can move up, but it can move down from there, a consolidation period. But that momentum of the chart is really being shown to me by the MACD. So it's a really great indicator to show me where is the momentum. It can tell you if the momentum has stopped, and so you might want to just come out of a trade, or it can tell you when the momentum is changing, confirm a signal for you, and then you can use that to go into some other trades based on a lot of other kind of metrics as well. But MACD is a great metric, and it definitely can help you with the momentum of a trade. I want to quickly touch on something that I use for the medium and longer term when I'm trading or buying and selling, and that is areas of value. So when you trade very, very short term, then obviously you need to be much more specific about the price levels that you get in at, and also your stop loss and take profit if you have them. When you're trading very short term or day trading, I would suggest those. When you're trading for the medium or longer term, it becomes slightly more difficult to put, stop losses in there. You can do, but obviously long term for a hodl portfolio, you're not going to have a stop loss. And so getting, very specific about prices is not logical. So what I do for the medium and longer term is use something called areas of value. What is an area of value? Well, it's just really an area of significant trade or price consolidation. And I'll show you that on the chart in a second. But obviously when you're trading longer term, it's not logical to trade to a specific price, because obviously the further out you get, the less likely it is that you're going to predict something more accurately, right? So it's just like predicting the weather, predicting it tomorrow, you have more chance of being right than, in a month's time. So, the way that I trade medium and longer term is really by looking at kind of the market cap, the value of the project, how is that going to change? Areas of value on the chart, and then you've got news, and we can kind of put all of these in place to read the market. But areas of value for me for the medium and longer term is something to look at. So let me show you what I mean by that. A lot of people will put lines on the chart. So you've seen me draw trend lines, and you'll see me in other videos drawing trend lines, and yeah, you can do that for sure. So we'll just zoom in here, and it's very easy to put trend lines on the chart, right? So you can really just draw trend lines in any way. So you come up, you draw a trend line, let's, you can just very easily say, well, that's an area of support, right? Because you can see the price came down, and then it met support right here. It bounced off this level a couple of times, and that is obviously an area of value, right? So an area of value is where the trade consolidates in some way. So it either meets support to the downside or resistance to the upside. And when it kind of consolidates, might be for a day. Obviously, it depends what time scale that you're on in terms of the chart. But they do stand out after a while. So you can see that this is definitely an area of value. This level down here, and then this support is an area of value. We had resistance up here, and you can see the price touched it one time. Got sold off, touched it a second time, got sold off, touched it a third time, got sold off. So that is obviously an area of value right here. And that just happens to show up. So if I draw this trend line kind of roughly, and for some reason, when you draw on the charts, it's just always not very easy to see. So you'll see that here. That trend line is very specifically a massive area of value, right? You have resistance here, it turns into resistance again. So it kind of popped through, then got sold off again, popped through to the upside, and then you got support down here. So this is a trend line, but it doesn't tell me much. What is easier to think about is areas of value, because nothing, especially charts in the real world, they do not trade specifically to trend lines, right? These are things that we try and put on the chart for our own benefit, but there are many factors outside of our control that affect the price of an asset. That is why technical analysis, for me personally, will never be the be-all and end-all to anything. For me, it's more about the price of money, interest rates, what the economy is doing, right? That's way more important. And specifically for smaller projects, what's going to be more important is how's the project doing? Who's investing in it? Is there a news event that's coming up that's going to change the way people look at the project and the amount of supply and demand in that? All of that is much more difficult to read on a daily basis, which is why some people stick only to TA, because it is easier, right? They just say, no, I'm not going to deal with all of this hard stuff to negotiate through every day, and I'm just going to stick to the charts, which is fine. It's their choice. But I traded for years in the stock market, and I know that fundamental analysis and everything that's happening in the real world is much more important for prices rather than specific trend lines. But we can get these areas of value on the chart, and this tells us where things might go. So for example, this area of value right here, we saw this support level. So we saw this trade around here. Then we moved on to a different phase. And then obviously we sold off and met support here. And we moved on to a different phase. So what we're looking at is, instead of a trend line, and this trend line right here would be a support level, what I would be looking for is kind of an area of value like this. So we would move back down to this area of value potentially, right? When you're moving to the downside, you're looking at areas of support to revisit to see if you're still holding that support or not. So what I would do here is, you'd say, okay, 40,000 is the trend line, but really what I'm looking at is probably this area of value right here. So this would be, between 42 and 40. When you're looking at longer term trading, if you're looking, well, maybe I'll pick some up, then obviously areas of value just a little bit easier. When you're day trading, so if I go to maybe the 1 hour chart right here, just reset that. Now we're looking, right, we need to be way more specific, right? If you're trading, let's say within the hour or maybe a few hours, then you have to get way more specific about your prices, because really what you're trading now is other people's orders and other people's trades. The longer out that you look, obviously what you're trading more is just kind of macro market dynamics. So areas of value are great to put on the chart, I think, to give you an area that you may want to trade at and an area that the price may consolidate around. Trend lines are great, but very specific for medium and longer term trading, but it's something to look at. Areas of value are very useful to just see the general trend of trades and general areas where the price might go. This video is really some key tips for using candles. So you've gone through and seen what candles are and some of the trends and everything, and those are textbook kind of explanations of them. I want to go through some kind of real world analysis that I think about candlesticks in general, and how to think about them when trading. So the first thing is that absolutely candlesticks do not control the market. They are going to give you a lot of kind of false indicators, and you really have to understand where the market is in its cycle and where traders are first before actually going and looking at candles. Candles really are an entry, but you have to get the entry right and understand where we are in the market in general before using the candle. So the broader trend for sure is really, really important. So, are we in a downtrend or an uptrend, or where do you think we'll be during the period of your trade? So that's really important to know. And candlesticks can't tell you that. So you're going to have to do more analysis, fundamental analysis of news and events and everything like that. What I would say is only trade with the trend when you're trading, right? So if you're an investor, very different to trading. So trading is more, okay, I have a timeline of 2 weeks, or I have a timeline, this news event is coming out in 10 days, or, I have a day trade and I want to get out of it in 2 days. Here are the price levels that I'm in and out at, and I've decided on the trend based on my technical analysis. So yeah, news and the economy is going to drive the trend way more, and candles aren't going to be able to tell you that. Maybe look at the 200 period moving average. If you want to look at a day chart, 200 day moving average, and see where you are. If you're above that, or that seems like it's support, then we're in an uptrend. If the 200 MA seems like it's resistance, then we may be in a downtrend. Probably only trade with the trend, right? So it's going to be easier. So one of the things I would say is don't chase the candles. Don't chase them in, because there is usually a pullback in trade at some point. It's really the pullback, if you're a day trader, right? It's really the pullback towards the support is when you're getting in. You're just giving yourself a much bigger buffer. Let me explain that. So we can see right here that there's definitely an uptrend from a low, right? And what you'd be doing right here is kind of chasing candles. And this might not be a great time to get in. It might very well be a good time to get in, and it would have pretty much been a good trade all through here. But the problem is that there is usually, when you have a nice move up like this, there's usually some sort of pullback towards support. People that have made money. So if some people bought in around here and they were kind of bottom fishing, when the price goes up, they're like, right, that was a good trade, I'm going to sell out. And you didn't have it for a long time. So you were probably going to FOMO, right? You're thinking, I need to chase this candle. It keeps going up. There's no pullback, and I need to get in. And then what you could have done is maybe get in one of these two, and you can see that the actual payoff isn't very high. Now we get the pullback. So that is really maybe the time to go in, is to say, okay, we have a pullback. Let's try and wait for the second wave of this trend. And we obviously in an uptrend here, coming off a low. We can see this uptrend pullback. Is it going to test the low? No, it's not. We get a couple of bullish candles, probably try and get in again. And then, it's definitely a little bit more choppy trade, but it's kind of more solid, because during this kind of up phase, very difficult to get in and FOMO in. But when you have this little pullback, you're saying, okay, we've got like a 2 or 3% kind of realization. Those sellers are coming in. Will they go again? That's just one thing to look for, is maybe, not FOMOing in and, being too late, saying, let's wait for a pullback. It doesn't always happen. This is day trading and not investing. Day trading is very, very difficult, but just waiting for a pullback there. If the chart prints a few bullish candles, maybe the move, is just away from you, right? So you have to say, right, the move's away from me. Let's kind of go again and see where the next phase, see where the next cycle is. When day trading, definitely there are, mini cycles right here. Maybe this is a better time to get in, even though, right here, I think this is a better time to get in than here, because you're at the top of this move, and so a pullback is probably coming at some point, right? Just a little sell-off and reversion. And what you don't want to be doing is kind of FOMOing in and then receiving a pullback straight away. It's much nicer during an uptrend actually to say, I'll basically buy the dip, right? Buy a mini dip, buy a little pullback, and then you say, okay, we've got a couple of percentage points that we can, play with here. So that's what I think when I'm trading. It is very difficult to kind of explain, but I think if you want to go ahead and day trade, you get some experience of how the market moves, and the events and everything will definitely change the market. So that's one thing. The next one, definitely trade with the trend overall and wait for those pullbacks. And then areas of value, absolutely look for areas of value on the chart that you can see. So like I said, when you see support and resistance, mark it on the chart. I like to use boxes. You can use lines and then have a buffer up and down. But those areas of value are prices where I would expect the price to come and test. So this is a definite area of value. So like I said, we'll just come back here. What we can do is take these areas of value, and then when the chart gets around them again, that's where we may want to trade. So for example, you saw a little bit of support and resistance here. There was actually resistance and it kind of broke through. So that was resistance, but then you have support here. So obviously if we just blur out kind of the right-hand side, everything right of my cursor right now, and let's say we were trading here, this is obviously an area of support. So coming down, you would look at this and say, are we still in the trend? Is the trend still happening? And it did bounce off that. So for sure, that would be, okay, we got a couple of candles right here. And again, try and wait for a pullback. If you see one, there's a little pullback and consolidation here. So it is extremely difficult to day trade and try and see areas of value, but try and get them on the chart with the support and resistance lines so you can see them. There's kind of another mini line here. So that would be a resistance period. And you can see that actually, basically this area of value right here between this resistance turn support and then this resistance, it actually played out here as well. If you believe we're still in an uptrend and the news is good, maybe a time to get in. Again, not chasing FOMO green candles, great green candles here, but maybe looking for a slight pullback. For this one, would have maybe looked to have seen the chart pull back a little bit further, but it didn't. And obviously the news and events that happened at that time pushed it much further. So again, candles can only be a small amount of the trade. You have to also look at news and events, market sentiment, potentially try and get pullbacks and not chase it. And then only go long when the price comes back to that support and bounce. I think there's some tips. Very difficult to give very specific key tips to day trading because there are very many factors with day trading, including all of the real world stuff that really should influence you more than the areas of value. But you get the areas of value on, see if things are trending, go with the trend at all times, and don't FOMO into those candles. The first thing I do when looking to day trade or enter into a very short-term trade is to firstly identify the trend that we're in. Not just the chart, but the actual market trend. This is obviously going to influence the chart itself, right? The chart doesn't influence the market influences the chart. So we can use both technical analysis and also market analysis generally to try and identify the general trend initially. I personally would never trade against the trend. You're just trying to trade against the market, and the market has a lot more money than you and I, right? So trying to find the trend and trading with it will just give us, a higher probability of actually having profitable trades over the long term. So the first thing we can do is use technicals. Something like the 200 period moving average is a long-term trend. And then you can find some shorter term trends as well by using the 50 period or the 20 period. Also, chart patterns that we've looked at can also help us to identify the trend. So just coming over to the chart right now. So obviously, as I am filming this, we've seen a huge sell-off in Bitcoin. This is, from an all-time high. Now, this obviously feeds into kind of trying to figure out the market trend as well. Because, why is the price selling off is obviously much more important than, the price is selling off, right? The price tells us one thing, but the market is going to tell us why the trend is happening, how long it might be. And obviously, if we can enter into a trade knowing the market trend, right? So first thing I'm going to do is use technicals on there just to find some levels. So we'll go to add in here indicators, and then obviously find the moving average right here. I'm going to put a couple on. And then what I would do very simply is obviously go and do like a 200 period moving average, something like that. And that can be on the chart. And then you'll obviously change these to kind of maybe 50 and 20. So that just gives you some very basic and actually very useful levels of the trade. So what we can see right now is the 200 period moving average, 50 and 20. We're kind of below all of them, right? So obviously this is obvious because the price has come down, but it's telling me that we're in a pretty harsh sell-off. So that's fine. And you can trade on technicals, but what's more important is, what is actually happening? Why is this happening? Is it a technical sell-off towards a trend during a wider uptrend? And so you would be going long and buying that dip, or Is the price coming off because of actually fundamental stuff that's going on with the economy that is fundamentally quite bearish for asset prices? And then what we should be doing, if we consider it to be a wider downtrend forced by the market, then what you'd be doing is basically going short on any rises in price, right? So if there's if the market is selling off overall, then you should not be going long, right? Even you shouldn't be buying dips. If the market is in an uptrend, you should be buying dips. So that's obviously something that you have to look, and this is a massive amount of time, right? To be a day trader is basically most of the time is trying to analyze what's going on in the market, what's going on with jobs numbers, inflation rates, interest rates, what's the Fed doing, what are other central banks doing, all of this stuff. Unfortunately, if you just trade on the chart, you're missing out a lot of information that would help you trade. So you can just do it on the chart, but obviously we can't go through too much in this specific video, but just keeping up with the economy, keeping up with what's happening, keeping up with what people are saying about where they say interest rates and the economy and what the Fed is going to do, other central banks, coming to something like interest rates. So this is really, really important to look at treasury yields. So the 10-year right here, there are different term treasuries. You get 2, 5, 10, 30-year. The 10-year is really the main one, right? The main duration that people look at for really a kind of medium term look at the economy. 30-year rates, obviously, it's too far out. 10-year is the main rate that people look at. So what you see recently is that the main rate has gone from 1.4 to 1.8 in a matter of weeks. This is a huge move in terms of interest rates and treasury yields. This is obviously going to have an impact on the market, and we can get way more into the fundamentals about what's happening here in terms of the trend. But really, as a trader now, what I'm thinking is, okay, what's happening in the future? Have rates moved up to a level where they're going to consolidate here, or are they going to move up higher? Obviously, there's been a huge kind of sell-off in risk assets recently as of making this video for various reasons, because interest rates are going up, inflation is quite high, which means now crypto is seen as an inflation hedge. I believe it is long-term, but short-term, because inflation is so high as of making this video, the market is scared that the Fed is going to have to come in and absolutely wallop the market with very high interest rates. And so you're seeing that sell off because essentially, short term, they're scared that the Fed is going to do something. Long term, an inflation hedge for me is something whose growth rate is higher than the rate of inflation. That's a long-term inflation hedge. Short term, you can't buy something that hedges inflation short term in a risk asset, right? So short term trading, all of this plays in my mind, not just the technicals. So the fundamental trends absolutely are so important, and you can tell, obviously, this is where the money's made, right? Using technicals is actually quite simple, and it gives you these specific levels that you trade at, but the fundamental stuff is a lifelong kind of quest for understanding how the market moves. So I've been doing it over a decade, and you get to know certain things and how the central banks want things to happen. But it's very, very much more difficult than just saying, hey, look, if the price is under this line, trade it. It's not that simple, but technically you can see that on the chart. So technicals plus fundamentals. What I would say is, once I've got in my mind what the trend is, don't fight the market, right? So at the moment, what I would be seeing is we have this huge sell-off. Now, is the sell-off done? Is it finished? Right? So that's the question that you have to ask yourself. Are we still in a bit of a downtrend for risk assets, or has that move happened, right? So has all of the news and events kind of been digested by the market, and actually fundamentally what's happening in the market is still fairly positive overall? Those are questions you have to ask yourself, which will really shape your trade way more than just having a technical on a chart. Also really important with trends, when you're day trading, what you're actually doing is trading trader sentiment and news. So when you day trade, all of the fundamentals of Bitcoin as, a growing network, lots of people coming on and developing, all of that is zero relevance when you are day trading. When you're day trading, the only thing that you're actually trading is market sentiment and the view of other traders on what is happening. So you're basically in a fight with other traders and the market and what all the other investment funds and hedge funds are doing to position their portfolios versus yours. So that is what day trading is, really. You're trading sentiment of other traders based on short-term news events. The fundamental value of any project goes out the window. You're just trading prices and other traders' orders. So all of this has to come in mind. So what is the general trend? What are other investment funds doing? Because when the economy goes from left to right and up and down, people and other hedge funds will position their orders in certain ways. And if you vaguely know this, then obviously you can kind of identify the trend a little bit easier and trade with that trend, either to the upside or if you think asset prices are going to be a little bit soft, as well to the downside. Once you've got some fundamentals in place, you know where the market is kind of and where you think the market might go now based on, the fundamentals, technicals, and if you think we're in kind of a cycle in the market, right? So there are cycles, there are mini cycles, there are weekly cycles based on jobs reports, inflation figures, all of this stuff moves the market generally week to week. And that's what we're trading when we're day trading. The fundamentals of anything goes out the window. What we're trading is jobs figures, CPI, all of this, non-farm payrolls. That's what we're trading. And we're trading the other traders' sentiment of those, right? So we can say, do we think that the market is positioned in a way that, they are correct or wrong on this figure, on the non-farm payrolls, on the economy? If they're slightly wrong, then obviously there will be, some volatility, and that's what we can trade. Or if you think, hey, you know what, this market is slightly oversold. I think the economy is in a better place. Hedge funds are moving their funds from one to the other because of something else, and I can, I know what I'm trading, and I think we can hit support here and then move up or something like that. So it's very difficult to day trade, but you have to kind of bear all of these things in mind. So once we've got that trend and we think we're in a place we can move forward, the second thing is to understand the price action and identify the price action. So where is the trade? Where is the trade? That's like what we would say, if we were trading. Where's the trade, right? So what we can see here is, and if you follow my YouTube channel, you'll know that every so often I do market updates. I just kind of update on the price and everything like that. So you can see 3 support and resistance levels that I've drawn on the chart, and then what I call areas of value. Because obviously the chart doesn't trade to perfect lines, right? So you just have to kind of find areas that the trade is around, and there's a lot of trade there, and that tells me there's a bit more certainty about price levels. So what I mean by that is what we see right here, and this is a good example. You just see a lot of chop and trade around this level. And this tells me that essentially this is a strong price level. When there are a few days, 3, 4, 5 days of trade around a certain price level, that's kind of a very strong indicator that is an important price level where sellers and buyers are kind of meeting equilibrium. And there's a lot of chop and trade around a price level. So we can look at those price levels as places where the trade might go to when it's ranging from a high to a low. So this one for sure is a very important price level just from the chart. And then if you read across, you can see it's 40,000 basically on the downside, which is obviously a huge key level. Humans like to trade to round numbers. 40K is obviously a big number. 50K would be the same. And obviously 60. So we can see a huge area of support here, or kind of area of value. And then what we see when the chart has come off is that we're also getting areas of value here, right? So what I've drawn on these lines is that you can essentially see the areas of value, the consolidation, the support and resistance areas. This is a key area, right? And this just stands out to me right here as an area of resistance, right? So we had the price move up, and then it met resistance, and then it chopped around this level, trying to break through this level for like 10 days, and then eventually went up and then got sold off straight away. So this is obviously a key level for me, as an area of resistance. But when you do break it, it does turn into support. And you can see on the right-hand side, kind of the second area of value that also did almost have a level of support here, but it basically broke through straight away. So obviously we'll be looking at the next level, either here or this level here, as support and resistance as well. So what happened to the chart is actually found support basically at this lower level. So this level obviously didn't really like it up there in the second area. And it actually turned into resistance once more. So it came through, just broke this, and this area kind of came resistance. And you can see that it's slightly above this left area. So that's why I say areas of value are good rather than specific trend lines, because it never, trades exactly to that. So this resistance kind of played out here as well as resistance. And then if we move down, this area of support, you can see on the left-hand side, loads of support here, loads of support here, that turned into support as well. So that's why I draw these two lines on, and then areas of value. So what we can see, obviously, is that it moved down again. A huge sell-off, right? The Fed moved this market and there was huge sell-offs. And then again, if you go to the third line that I drew, another area definitely here, you can see this is a kind of area of value moving across to this level of support, definitely a support line. So you can move that across to the chart as well. And, it does, the chart definitely does trade to areas of value and support and resistance. You can see once again, we meet a huge area of support right here. And that just happens to be the 40,000 level, which is obviously a very, very key level for this asset, which is Bitcoin. What we can also see during a huge dump and a sell-off is that we get a great entry right here, or a candlestick, a massive sell-off and a wick, and then it got bought into. So this 40,000, I would say, is a key area of support for the price at the moment, and it seems to be holding. So, what I would suggest is this is now probably a time that you could actually look to enter a trade. What I would say is that this down move might be done, because we're seeing a kind of a lot of selling in the price and a lot of correlation between tech stocks and everything selling off massively. That has brought Bitcoin down. Are we going to get a little relief rally right here? Is there going to be a relief rally? Everything that the chart is telling me and the fundamentals is that everything's quite bearish right now, but are we about to enter a new phase and actually have a little bit of a relief rally over the next week or so? That could happen because the market seems to have repriced assets. Tons of NASDAQ stocks are off like 50% from their highs. Is it done? You could suggest that it is, and there's some levels right here that we could trade around. So just to kind of finish off this video, find the local and the secondary areas of support and resistance like you've seen on the chart with the levels. Go back to the chart, see if there are previous levels that you can trade to, and does it seem like a good entry point? For me, what I mean by this is, if it feels like you can, and you're seeing areas of support and resistance that you can put some stop losses and take profits on, then we can move forward. This seems like a decent chart. All of the news and everything's been very negative recently, but maybe we're turning a corner a little bit. Maybe we're having a relief rally, and maybe as a day trade off this very important support right here that we've got, possibly a time to go in. If you want to trade bearish, I think we also have a potential trade here if we see the price move up to this resistance level as well. This could be an area where we could basically trade 40 to 44 and see if that would trade with a very kind of solid wick right here that we could place some stop losses if we go long. So I think this is a pretty decent setup for a trade, simply for risk and reward. So just kind of getting that in your mind, and obviously a lot of experience is going to help with this over time in terms of getting levels and seeing if the risk is worth a potential reward onto the upside. The next thing to do is to actually just go ahead and trade and find your entry and exit points. When you are short-term trading, day trading, even swing trading, I always would put in a specific profit and loss beforehand. When I'm investing, I'm just buying and holding for the long term. I want to accumulate those assets, have them grow over time, earn some yield from them. That is different to trading. Trading, you have to just have a specific area that you want to get out at. Day trading, even more so. Day trading, you need to know your profit and loss when you trade and put those levels in and just let the trade run out at that point. Everything that you've done previous has basically set you up to take this trade, and that's it. And there's no kind of changing, during the time. If you make a profit from your day trade, happy days, and move on to the next one. So yeah, that is day trading. You have to be specific. You can't change halfway through. You can definitely change your take profits, right? So, if the trade is going really well for you and, you're seeing kind of a big move up in the market and you're like, wow, this is great. Just basically what you can do is move your stop loss up to kind of break even or something. So you're definitely not going to lose money. And then maybe say, hey, look, this trade's going better than I expected. I can move my take profit up as well, maybe to the next level of resistance or just underneath it, to try and make even more out of the trade. That's something you can do. But certainly your outlook on the trade, if you start changing your outlook, if it's moving against you, you just have to say, okay, look, my stop loss is in place, and if the trade goes against me, then it has just gone wrong, which will happen a lot. You cannot predict the market accurately 100% of the time. So really getting in the right way is the thing, right? So not after you trade, but before you trade, getting everything set up. So find your entry and exit points. Also find your take profit and stop loss levels before the trade. If the TPSL doesn't look good, and risk reward, right? If your risk reward ratio doesn't look good before the trade, then don't get into the trade. It has to look good beforehand for you to get in. And then if it's moving in your direction, then you can maybe, move up your stop loss and take profits to try and get a little bit more out of the trade. But I wouldn't go into something thinking, I'll just see how it plays out, and maybe I'll kind of move around bits and, kind of like the levels afterwards. That would not be a solid trade. So what the candle's telling you, this is actually another great example in the real world, which is happening right now with Bitcoin. So what I'm going to do, I think, is if we go to the 1 hour, let's see if we can get that wick, because this is just an amazing wick, right? So, what happened essentially, so I'm filming this video, I think, on a Tuesday. So Monday was obviously the open for the regular stock market, which is, the stock market has been basically moving the crypto market recently. Massive sell-offs in tech and the NASDAQ and everything, and that's been feeding through to crypto. What was a great wick here is we've seen this huge sell-off, and then right here, I actually posted this on Twitter. You can just see a massive area of trade right here. Sellers came in and really forcibly tried to short and send the price of Bitcoin down. And what you see is this huge spike in volume right here. And from a low of 39.6, where it wicked down to in this time period, buyers just rocketed in and pushed it right back up all the way. And the candle actually finished green, even though it was kind of, basically break even, right? Because there's no body to the candlestick. But what a bullish candle that is, right? There is just obviously a massive amount of support around 40,000. That's what that is telling me. So like I've said, candles don't tell you everything, but they can really tell you exactly where trade is and what traders are doing and how they're fighting. Sellers came in, tried to push it down, and there was just an immense amount of buying pressure that came in, pushed it back up. And then you've seen the next two sessions are really bullish as well, and you're getting some more buying. What I would suggest here is, like, we're at a key level, right? We're still kind of in a downtrend. There's no getting away from that. And you can see that 40 is obviously a key level. Are we going to move up? Are we going to keep moving up and actually have these two moving averages as support now? Because they've been resistance the whole time. See them resistance here, trade moved up. Those two moving averages have been resistance as well. Trade moved up and consolidated, got sold off from this moving average again. And you can see it's just been a complete resistance level. Tried to move up, got rejected again, and now it's trying to move up again. Is this it? Is this the move up or not, right? Are we just seeing another little relief rally, short covering, whatever it is, and then moving down again? Like I say, don't go against the trend, but you have to sometimes think, is it finished, right? Is the selling finished? Are we at this level now where we see this huge wick and this huge spike of volume where I'm confident enough that 40,000 is a key level of support? So what I would say here is that you could make a case for both going long and short here. Going short at this level because it's obviously a key resistance level, as you can see, and maybe testing those buyers again. Or we've just had so many buyers here that we're probably going to move up and kind of just have a relief kind of rally up to maybe 43 or 44. I could make the case for both of those. So actually what I'm going to just show you is how to go long and short. When you're day trading, obviously look at the day candle, but obviously look at the 1 hour as well, because you want to know kind of where the real trade is short term, because you want to get your prices in. Now what we can do is actually put our stop loss take profit on using some metrics. So you can use the ATR or you can use areas of support and resistance to do this. I'll show you with the ATR, technical indicator, ATR, which I've talked about in previous videos, average true range. And the average true range is quite low right now comparatively. So the average true range is about $500. So that's taking me down to kind of 41.5, something like that. It seems quite a close stop loss. As you can see here, you can definitely see an area of support right here for the kind of 1 hour chart that we're in, right? So that's 41.5 is telling me that's the support level. That's a little bit close for me. I would like to take a little bit more risk here and actually kind of place my stop loss kind of around 40,000, something like that. I think maybe 40,500 is okay, right? So you need to give yourself some breathing space. So I would personally not put it 500. I think that's a little bit close because we could easily test this line again. You can see they're testing this line. So I would place my order around 40,500. To be honest, maybe a little bit lower, 40,000, something like that. I don't think that's, that's kind of a bad. Yeah, so that's about 5% to the downside. I think that's okay, right? So about 5%, I think is fine. So that is where I would put my stop loss if I was going long, right? So you have to look at this level and say, look, this is too close. It could very easily test this. And what will happen is, it might test that line and you just get stopped out, but you actually write and it moves up again from this line. So you need to give yourself some space. So I would actually move it down, say 40,500 is around, a 4.7% downside move, which I say would be pretty decent for not for a day trade, but maybe for a kind of a longer term, maybe week long swing trade. If we're going to kind of move into the end of the week to the upside, we could see that move. So I would say around this level, 40,500, maybe 40,700, something like that, to the downside. Now, if you're losing 4.7% to the downside, if that happens, then you would want to be making, as a risk reward, let's just round it up to say 5%, okay? So that's your potential loss. The potential reward has to be more than 5%. Otherwise, you've got kind of a 50-50 trade, and I wouldn't like to go into a kind of a 50-50 trade. So the potential win for me would have to kind of be 7.5%, something like that, for the trade. So that's quite a big move, but obviously to the downside as well, we've got 5%. If you look at this, let's go to the day chart. I would say, zoom in here. I would say a move up to this level, is probably going to happen as a relief rally, or the trade moves down if you want to go short. So 5% to the downside, you would need at least 7% to the upside. Let's say a 7% move overall, which is obviously a lot, but it happens, Bitcoin is volatile. 7% move would be on 42,000 would be roughly 44,100, right? So if we look again at the price and come down to this, 44,700, or let's just call it 44,500, just happens to be at that second level. So what you're seeing is the chart actually trading right in this range now. So before even coming to do this video, the areas of value that I've put on the chart, support and resistance here, just happen to be what we're trading. If you can see that on the long side. So yeah, that just tells you perfectly. Essentially what we're doing now is basically trading the two trend lines, right? So that is what we're trading. We are trading a bounce off this bottom trend line up to the top trend line, essentially what we're doing. And we're thinking that if we place a stop loss down just below this trend line, then that's our risk mitigation. And we're looking for a bounce off this trend line up towards this, and then at this level we'll take profit. So it just happens to be between these two trend lines that we're trading, around 5% to the downside, 7.5, 7, or a little bit more to the upside. So you can play around exactly with those numbers if you want to get a good ratio. But that is how I would trade to the long side for this trade. If you want to go short, going short here, slightly more difficult. What I would maybe do is wait for the little rally because we're in a downtrend, right? Like you can see that. And obviously we have to make a decision if that downtrend is maybe finished, all that selling is finished and we might start to move up again. But I would say to the long side here, essentially what we're doing is just trading these two levels, going long at the bottom and short at the top, right? So what I would do here is actually wait for this to print before going short. If it goes up a little bit, then I'd maybe, if I was, saying we're still in a downtrend, look to go short up around this level towards the top one, have a little bit above that as my stop loss, maybe at these moving averages here, like 3% above, 4% above, and then to the downside, going short, you want to buy back here. Now, I'm trading in the spot market here. This is a spot market screen. I'm talking about going short. When you go short, you trade futures. You have to trade futures. You can't go short in the spot market. Futures are way different. I would always trade futures when day trading. They're more liquid. They're lower priced in terms of trading fees. And you can do take profit, stop loss much easier, and also sell short. So it's basically just like betting on the price. So I'm just showing you this as a chart and as an example of what I would do. But hopefully that kind of goes through some of my thoughts about putting trades on the chart and the areas that I would get into, right? So, it just so happens that for this example, it just perfectly lines up with basically trading these two areas of value that I put on the chart a long time ago. And the trade is trading around these two levels. Found support here. And of course, it just makes sense to kind of go long at the bottom and try and ride the move up to this resistance level and then go again. And then obviously you can make decisions. If the price is moving up, just move your stop loss up a little bit and say, hey, look, I've got no risk in the trade now. That is kind of what I would go through for a day trade, looking at the ATR, and you've seen in the real world how the ATR can help you, but I would change it a little bit based on where the chart is actually trading, because what you can do is take the ATR. It may make you a little bit close for your stop loss, because what might happen here is that this trades down a little bit closer, stops you out, but actually you were right. You were right on your trade, but your stop loss was too close. And so you got kind of, faked out of the market, which does happen a lot as well. So all of this comes with a little bit of experience to levels that you might want to look at. Obviously, knowing one asset that you're trading, how it trades as well is really important. But they're really the ways that I would put together a trade, put together levels, and then put a stop loss in and a take profit, and then ride out the trade. This is a follow-on video from the last video in the course, which is about day trading and your entries and everything like that. So I'm actually a few days on in time now. So when I'm recording this, as you can see in the top right-hand corner, it's Thursday the 13th. So I think it's a couple of days on from when I filmed that last video about entry points, putting in stop losses, trying to find areas of value to kind of trade against, and making sure your risk management is in place. So a couple of days has passed, and I just want to see where the market is right now, and go through what I would kind of do with an open trade. So in that last video, I was really talking about, making sure your risk reward is in place. And what I mean by that is, it's fine to say, oh, look, we can make this much, but that's not the idea of trading. Every single thing that I do when I invest and when I trade is based on risk and not reward. The reward is a given. The reward is something that is expected and normal when you invest in a risk asset, because that's the whole point of investing or trading it. but the risk is what separates professionals from people that, obviously haven't had experience trading professionally in the market, trading stocks and whatever. So it is all about risk. If there is one thing you can take away from this entire course, it is about knowing what your risk preference is and managing your risk when you trade and invest. So what I was saying in the previous video is that, I would go long at this point. And I also said, don't trade against the trend. And obviously there's two trends. There's the short-term trend and the longer-term trend. Longer-term trend is clearly still to the upside, but short-term, we do have some big choppiness. And when I'm recording this video, the market is kind of in flux right now in terms of what they think will happen. So, I said probably, what I would do with this trade, because when we were trading this, I think we were down at about 41.5, maybe 42,000, something like that, down at this level, probably about 42. And I was saying I wouldn't go short here because we've already had this move and we're at the bottom of a range meeting support. So you saw that support, that big candle there, that is support. So I wouldn't go short here because the candle is telling me we're probably going to have a relief rally up to this resistance right here. So the risk reward in my mind would be to go long at the bottom range, and if you still believe that the short-term trend is down, to actually wait until the price moves up to this level and then short it there, potentially testing those lows again. That is what I was saying in that video. So here we are a few days later. So what you can see is that relief rally did come. This is not because of Bitcoin. Bitcoin itself didn't kind of spark this rally. It's really the market in general, right? So the stock market had a big bid up. Jerome Powell from the Fed came out in a new testimony, and he was kind of, fairly more dovish. This big move down was because of inflation figures. The market actually sold off before those inflation figures, and when the inflation figures came out, the market kind of bought back their shorts, basically, covered their shorts because they basically knew the inflation figures were bad. That move came before the actual figures. When the figures come out, you get this kind of relief rally. So what I would have done here, if I'd have gone long, is get in at whatever the price was. I can't remember exactly, maybe 42. And we're up now like, I think about 4 or 5%. So what I would do here, this is actually kind of a key level, right? Because we've got kind of a red candle right here. So it looks like potentially we are meeting a little bit of resistance once more at pretty much all of these resistance levels. You can see the moving averages are coming down. They have been resistance so far. So the question is now, what is going to happen? Do you go short here? If I was long at this level, what I would be doing is probably moving up my stop loss and reducing the potential loss that I would have, mainly because we're still in a very uncertain environment and we don't know how the interest rate hikes are going to affect the market, right? So this is obviously very specific for this trade. And at this point, I can't really give you theory. This has to be practical now, right? So at some point, you're just going to have to say, look, I know the theory. I'm just going to have to trade and try and figure out the market on a daily basis, because obviously theory only goes so far, and then you have to practically understand the market in different scenarios. Every scenario is different. That's what makes trading, kind of so interesting. So for now, what I'm thinking is interest rates are going up. This could have a detrimental effect on the market. There may be extra selling at resistance levels. We have a short-term downtrend, but a long-term uptrend. What would you do as a day trade? What I would do here is manage my risk and say, let's just move my stop loss up to somewhere near my probably, break even. If I lose like 0.5% or something, it's not a big deal, right? So that's up to you if you want to kind of put your stop loss a bit tighter. But that move has happened, right? So we did bounce off and we are meeting this resistance. Now, obviously there's two outcomes here. Firstly, the stock market in general keeps moving up. This may happen because it's earnings season and there are a few kind of big companies coming out with their earnings. I believe their earnings are going to be very good because inflation is high. And all of those companies have been saying, we have been able to pass on price rises to customers. Why is that? Because customers have been giving thousands of dollars of free money from the government, right? So that's inflation. Asset prices have inflated and now you're getting real world inflation as well. If those earnings are good, that means the stock market will go up, because when companies make more money, they get valued higher. That brings everything else up as well. including probably other risk assets like Bitcoin. So what we could see here is a little bit of resistance and then actually just a kind of breakthrough to a new level. That's what could happen. And so selling here is kind of difficult because you think, do I want to keep at risk and maybe have like a bigger move up? So you could potentially just sell here and take, the move would be around about 4%, from 42 to 44 or something like that would be kind of a 4% move. Now, that's just for the spot market. If you were trading futures and you were leveraging here, I would absolutely say probably take your money, because you'd be leveraging up. You would have made, like, let's say 2x leverage, you'd be making, twice as much, 8%, 10% or something if you want to use leverage. And that would be a good trade over 2 days, right? So, say, hey, look, you kind of bought a rally and that was it. If you're trading in the spot and you're trading a little bit longer term, I would up my stop loss here, because there's still many worries about potential news that comes out and spooks the market and it sells off. So look, if you just up your stop loss, you're kind of running a free trade right here. Maybe sell, like, it depends who you are, right? It depends what you think, but maybe sell 50% of the position and lock in that profit, and then maybe let the others run. So that's another option. So you have options here. The one thing that I can see that my head is telling me is that, look, this is still in a downtrend, right? You have a lower high here, you have a lower high here, have a lower low, lower low, lower low. The only time we actually break through this is if we get to 50, which is a really big move. So, they're the things that go through my mind. We might have a day or two of consolidation, and then actually another kind of try. So that's how that would play out. For a short-term trade, maybe up your stop loss, maybe take 50% off, if you want to just get out of the market, or just let it run, move up your stop loss, and then just let it run and say, hey, look, I've got a free trade here, and I think that we may go a little bit higher, and then set your stop loss up a bit, maybe 45,000, because that would really be the next area of resistance up here. So there's some of the things that I go through. Each single trade is very different depending on what the specific market kind of structure is at the time that you're looking at the trade, right? So there's just so many things to think about. Inflation figures, jobs figures, when do they come out, right? What day do they come out? Because that is going to affect things, and that should affect how you kind of go about, actually, I'm just going to get out of this trade because there's a jobs figure coming up and there's going to be volatile. I don't think we're in a great place. Let me get out of this trade and take that profit and run. And then after that jobs figure, maybe we can go again. So there's so many things that each individual trade has influencing it. The theory can only go so far. So this is how I would trade. So hopefully this video is kind of a follow-on from those 3 previous videos about the theory of getting in, setting risk. That's the most important thing. And then after that, it is a reactionary thing of like, the market's in a good place or a bad place, or I think this is resistance. I'm going to take half off the table, and that's how I would go. So this trade would have worked, a decent risk reward ratio. We're getting to the point where that take profit would have happened anyway. So, taking maybe a little bit off the table early, moving up the stop loss, letting the rest run out, see if you can get to like 45,000. So hopefully this is helpful as well in terms of not just the theory, but how I would trade, how, trading for 10 years and thinking about things that I don't even realize I'm thinking about. This all comes into play. And the only way that everyone's going to get better at this is trading, paper trading, if you don't want to put real money in, or just trading a small bit of your account and really getting some experience to kind of make those decisions, because it is an individual decision at the end of the day. And depending on who you are and what you think, different people can make different money in many different ways in the market. But as long as you have that strategy and you're thinking about all of the market as well, because that's really what changes things, then you should be doing well with trading. Make sure the number one thing is managing your risk, and then you can go from there. One of the most popular and well-used types of trading bot is called a grid trading bot. I'm going to show you how that works. I'm going to show you the pros and cons of it in this video, because I think there are a few different implications of using one that you might want to look at. Grid trading bots can actually be a very, very good tool and a useful tool for a lot of people, but it depends on your situation and what you're looking for. So obviously get that right and see if grid trading bots are for you. A grid trading bot is essentially something that a human being can't do, and that is it's almost like a high frequency trading system that a lot of hedge funds will use. And obviously they have many different options that they use, and they can front run other orders, and that's not what a grid trading bot does. But a grid trading bot essentially is basically like a market maker. Now a market maker is well, in the real world, when I used to broke, we used to trade with market makers, and they were actual people who would give prices. In the crypto world, you have automated market makers, which are computer systems that make prices. And a grid trading bot basically makes you a market maker as well, and you make prices. By making prices, what that means is that you have a buy price and a sell price. So that is the black one. You're actually becoming a market maker. You are making a market in an asset. You are both a buyer and a seller. Obviously you need to buy low and sell high. That's what a grid trading bot does. It essentially sets up a bunch of grids. So you can think of a grid as a buy and a sell at many different price points. And what you're trying to do is take advantage of volatility. And this is something that you specifically cannot do, right? Because you cannot put in 100 different buy and sell orders all at different prices and all at different limit orders. It just won't work, right? So a human being cannot trade like this. It's impossible. So we just used a grid bot. We can set all of the buys and sells up, and it will automatically trade for us. There are different types of bot. I'm actually going to go through to the different types, and I'm going to use the system I use, which is Pinex. And I've got some grids working here. We just had a sell-off the last day or so, and it's actually very good to prove a point that I want to make in this video about the benefits of grid bots. So there are different types of grid. I'm just going to zoom in here. So you have the normal type of grid. You also have a leveraged grid, a margin grid, which are actually pretty much the same thing, and a reverse grid. So I'll explain what those are. So yeah, you have futures grid, leverage grid, and reverse grid. So usually with a grid, you will be net long. So you will have a net long position. You'll be a buyer, right? So you will kind of buy low and sell high, and you'll buy first and get some tokens on your book, and then look to sell them at a later date higher, and it will just do that for you. A reverse grid is obviously the other way around, where you're kind of a net, or you have a net bias towards shorting the market. So what you're going to do is go ahead and sell a load of tokens first and get your sell orders in and kind of be a net seller, and then look to sell lower. And you can set the grid up how you want, but that's basically it. So one of the very important things to know about grid bots is that they are open to market risk. So because you're taking a risk position in the assets that you're trading, obviously if the price goes down, if you're a net long and the price goes down, then you are going to be in a loss, right? They cannot prevent against that over the short term, but I'll show you how they work to actually try and mitigate some of the volatility that will be in a trade. That's what they're trying to make money out of, volatility. Something to really be careful of is that they could potentially trigger capital gains because you're buying and selling, right? So obviously you have to take that into your own account wherever you are in the world, and how you get through that. There's obviously buys and sales that will go in the system that you can see, and you can put that into your tax software and whatever. But let me show you exactly how a trading grid bot works, right? So we have a market, and let's say the price is 100, 99, 98, 97, and the price starts, at 99. So essentially what will happen is that the grid bot will put in a bunch of buys, right? So you'll go buy here. Let's say you're net long, and let's say the price comes down. Then what you're going to do is actually buy some more right here. And then let's say the price comes down again. You're going to buy some more right here. So if you trade $1,000, it's going to have a bunch of orders for you, obviously in small amounts. Let's say $50 each, and you go buy, buy, buy. Now what's going to happen is that when the price starts going up again, what it will do is put a sell order in right here. And then the price goes up, and it will put a sell order in right here. So what's happened is that this buy has turned into a sell. and this buy has turned into a sell. They're known as a grid. And what it will do is basically refresh this all of the time. So let's say the price moves down again. It's obviously going to put in another buy here, and then the price moves up. It's going to sell, and it just basically does this the whole time. And this is essentially what it's doing, is taking advantage of volatility in the price, right? So the way you set up a grid is you say, I'm going to set a lower price limit. So that could be down here. This is the lower price limit, and this is the upper price limit. And they're my upper and lower bounds. And then in these, I want to set a number of grids. That could be 50 grids. You might have 100 grids. Obviously, more grids means the price difference between the grids is smaller, and fewer grids means that, let's say you had 2, then obviously it would be here to here. The problem with fewer grids is that you have to have a much more volatile move to actually have a buy and a sell. So it's much more difficult. The way I would do it is having many more grids, and I just want to take advantage of volatility and kind of print profits like that. The reason why you're still open to risk is because you can go here and you can buy. The price can keep moving down, and you've just bought a load of cryptocurrency, and the price moves down, and because it's underneath your lower bound, you can't do anything until the price moves back up. So you are still at market risk with a trading bot. Now, why I say that this is a fairly good thing to use, in my opinion, is because of the way that the volatility works, is that essentially as long as the price stays within your bounds, then even to the downside, you're actually reducing some of the downside loss that you're taking. And let me show you exactly what I mean by that. So I've just got 3 trading bots working. I actually put these on for another video just to show how trading grid bots work. And it's interesting to see what's happened. So what we can see is this is an Ethereum trading bot, right? And I put the trade on right here, and obviously the price has come down. So I actually, let's say I just had Ethereum in my wallet and I just had the long position there. Now the price has come down, right? So I've lost money either way. I've lost money when it's in my wallet, and I've lost money with the grid trading bot as well, obviously because the price is lower. So I have market risk. But what we can see here is that actually the grid is in profit. So because of the way that the grids are placed, and you can see the placed orders right here, right? So you can see all the different grids that are working through. So I have different grids, at different levels. These grids, because of the volatility in the price, and you can see that the price moving up and down, it is buying and selling and taking advantage of volatility. What you can see from the grid profit is that I've actually made money from this grid, despite the price coming down. I've made 4.7. I'm not sure if that's in dollars or if that's in ETH, like METH. METH is like 1,000th of an ETH. On Pinex, it's just how they do it because it's easier for them to show you in points, right? So I've actually made money from the grid bot. I've made 0.46% in the time scale, and I've made 4.7. Now, if you annualize that, this grid bot is annualizing at a 30% APR, or like an annualized rate of profit from the grids, which is very good. Now, obviously, the price has come down. So what I'm actually in a loss right now on the total position, because the price from when I first went, and I was a net long, it's down, right? So what's happened is that even though the price has come down, the grid bot has actually reduced my loss because it's printing grids and it's printing profits from buys and sells, taking advantage of volatility. So what's happened is that because I used this grid bot, my portfolio has actually fared better than just holding the asset. So if I was just holding Ethereum in my wallet and I just held it in cold storage and didn't do anything with it, I would be down more. I would be down 7.16%, but because of the grid bot and the way that it trades volatility, I've actually reduced that and I'm only down 6.67. Now, you can see that the placed orders right here, what we'll see is, I think it's transactions. You can see there's a few to be completed, right? So this grid has been completed. I bought at 3.44 and I sold at 3.47. So that's a grid that's traded. But you can see there's going to be a lot of grids that haven't been completed yet, right? Because they are buys on the way down that haven't been traded out on the way up. Now, in my opinion, over the long term, ETH is a good investment. I think it will continue to do pretty well and go to the upside. And so those grids will be traded out of. However, if it doesn't, and it stays within my lower and upper bounds, this grid bot is just going to keep printing money, right? So I should say printing profits as long as the grids are traded, right? So what you'll see is that if this drop kind of just stabilizes and then the volatility just stays within a period here, the grid is going to continue to keep printing these grids and printing these profits for me. And so that kind of loss that I've made from here downwards is at some point just going to be made back through the grid trading bots. Even if the price doesn't rise a lot, if it just keeps being volatile down at this level in the range, the price doesn't have to move too much. It just needs to move a couple of percentage points up and down continually. And the grid keeps printing those grids and claws back the money that I lost from that move down. So this is, it's a definite, advantage to using a grid bot is that if you just buy and hold, the only way that you make money is when the price goes up. If you're using some of your assets in a grid trading bot, then if the price goes down, you should still be printing, hopefully, some profits from the grid trading bot to reduce any price falls. And when the price goes up, you are again trading volatility and adding grid profits to any rises in price as well. So grid trading bots definitely worth looking at. Obviously there are risks, right? The risk is that the price falls down below the grid level and never comes back. Well, then I've lost that money on that downward move, but obviously I can start a new grid at the new level and try and print grids. So it's something to watch out for. You can see that the grid trading bot is annualizing about a 30% rate for this. For Matic, it's annualizing 48%. And for ADA, it's annualizing at 30% profits from that grid. And obviously the price, as long as it stays within a range and just ranges through that, it will take advantage of the volatility. So I think grid bots are something to watch out for. And obviously, if you're kind of short, you may want to try the leverage or the reverse grid. And then leverage grid and margin grid, they just use futures, which are slightly cheaper to trade, and you can leverage them, right? So if you have $1,000, you can actually open $2,000 or $3,000 worth of positions. That's much more risky. I almost never recommend using leverage unless you've got a very big portfolio and you really don't mind the loss. But yeah, grid bots are definitely something to watch out for. A spot futures arbitrage trading bot is something that takes advantage of the difference between the spot market and the futures market of cryptos. This is actually something that is used very often by hedge funds and other trading firms. It is something that has happened for a long time in the professional markets, and retail investors have never had this opportunity to kind of trade this. But with crypto, at least with Pinex, what I've seen, you can do it. So I'll show you what spot futures arbitrage is and then see how it works. So firstly, I have to explain what spot and futures are if you don't know. So obviously the spot market is the cash settled market. So you take 100 actual dollars and you buy $100 of Bitcoin. You own the Bitcoin, you actually own it, you cash settle it because you're using dollars. That could be, a stable coin in this case, but you have the cash and you buy the cash amount of the asset. That could be Bitcoin, could be, corn futures, pigs trotters not futures, sorry, but actual pigs trotters, actual oil, actual gold, right? So you spot settle it. Futures are very different. Obviously, futures are a synthetic contract and they have absolutely nothing to do with the actual asset. They are just completely synthetic. They are a contract and it says, you buy at this price, and then in the future, you agree to exchange. There is always a seller for every buyer with futures, right? So if you go long, there's always someone short because it's a contract between the long and the short at the price, that you make it at, right? So whatever the price is in the market, when you press go long, there's someone on the other side that's going short. And it's a contract between you and them to say in the future, you will exchange the difference in price between at the moment you execute and then the other moment that you execute. It is a completely synthetic contract between you and them on the basis of the price of the asset that you're trading at the time, right? So it has absolutely nothing to do with the asset. This is true for crypto. Because in futures with crypto, you can trade perpetual futures, meaning the contract just goes on and on and on. In the real world, a futures contract could actually have settlement. And obviously, you know, farmers will use futures, right? So they will say, hey, I want to sell you my wheat in the future so that I can get the money in now. And so that's how futures work, you know, in commodities and everything, but we won't get into all of that, right? So just that's the difference between spot and futures. So we have to move on to why is this important? Well, a trading bot can take advantage of the difference between the spot market and the futures market, right? So there's a spot market for Bitcoin where you cash settle, and there's a futures market for Bitcoin as well. And a spot futures trading arbitrage takes advantage of something called a funding rate that happens in the futures markets. So what you're looking to do with a spot futures arbitrage is receiving a funding from longs. And it's a market neutral strategy. If I've just confused you, let me explain. So the spot market, what we're going to do with this bot, take the bot out of it. What we're going to do right now is we're going to take some money and we're going to buy some Bitcoin in the spot market. So we take $500 and buy $500 of Bitcoin and put that into our account. We bought it in the spot market, and so we actually have Bitcoin settled into our account in the value of $500. We own that. There's no futures contract, there's no leverage, there's no anything else. We physically own, you can't physically own Bitcoin, but you know, stick with me, you physically own Bitcoin in that account. Now what we do, let's say we bought $500 worth. Now what we want to do is go and short Bitcoin. So that's take a bet on the price falling in the futures market. You cannot short Bitcoin in the spot market because you can't short something that you don't have. You can sell something and spot settle it straight away. So what we would do, like if you did that in the spot market, what you do is basically sell $500 worth of Bitcoin and now you have nothing, you have $500, you have no Bitcoin. So you can't, you know, buy, that's just buying and selling. That's not an arbitrage. What we want to do is go and short Bitcoin to the value of $500 in the futures market. So now what we have is we have a long position of $500 worth of Bitcoin in the spot market that we have in our account, and we have a short position of $500 in the futures market. This is known as market neutral because obviously we have both a long and a short of Bitcoin to the same value, and so we're not going to make any money whatsoever from the price going up or down because they will cancel each other out. If Bitcoin goes down 10%, our futures short makes money, but our spot loses, and vice versa. Why on earth would you want to do this? This is ridiculous, right? Well, you can take advantage of the futures funding. So what is futures funding? Just going to go over to that explanation on Binance. And they say when the funding rate is positive, the price of the perpetual contract is higher than the mark price. Thus, traders who are long pay shorts. Conversely, negative funding means that shorts will pay longs. So what we're really after here is that in the futures market, there is something called a funding, and that happens every so often throughout the day. And basically, it is a rate of interest that you have to pay to have the contract in existence. So when the funding rate is positive, longs pay shorts. So we want to take advantage of when the market is, or the funding is positive, when the market is kind of going long. We, as a short seller, will receive money from those longs in the futures market, and that's a funding rate. We actually just receive that as an interest and money in our account simply for being short. Now, the difference is we're market neutral, so we have a long and a short, so the price doesn't affect us, but we're collecting money from long traders in the futures market because we're short. So what we're doing is actually just receiving a funding rate. That's why it's an arbitrage. Market neutral, but receiving a funding rate for longs. So if we come down, what we can see is in the futures market, there'll be an index price and a mark price, right? So when the actual price of the future is above the mark price, and you can see that it was above and now it's flicked over, but usually the funding rate is positive when markets are going up. So what we can see is that the index price is actually below the mark price here, but that changes. It's changed again, right? So you can see the index price just below the mark price. So shorts will be paying longs here, but when the market usually is settled or just kind of edging up, the index price can be, and it's just changed there. You can see the index price is above the mark price here. So what happens on FTX is that the funding happens every 1 hour, and on other trading systems, it might happen every, I think maybe every few hours. When the funding rate is settled, if the index price is above the mark price, longs will pay shorts and vice versa. So what we're doing right now is taking a market neutral strategy. And we can see very simply on Pinex, and you don't have to use Pinex, right? I'm sure there are other providers out there. But for Bitcoin, the 180-day APR is 9%. So just with a market neutral strategy, not going long, not going short, just market neutral, this arbitrage bot is yielding 10% a year from taking that funding from the longs. You can also, let's choose another coin, like ETH or something like that. We'll just see what that's doing. So the funding, 180-day APR is 10% for that. ADA 13%. So you can trade any of these. DOT is 9%. Essentially what you're doing is just trading an arbitrage between spot and futures markets where you are market neutral. You're not taking a position either long or short. The price doesn't affect you. You're just taking an arbitrage out of these. Something to look at for sure. Definitely works better in markets that are ranging up, because there will be a lot more times when people will be going long and paying shorts the funding fee. So you'll be making a lot more money when the market is going up. When the market is trading down or a little bit more, you can see it's trading down now. It's still making 10% a year. So something to look at that you might want to do as part of a strategy of trying to earn some yield from your assets.